sentiment is no longer bearish. We're now in a bullish position.
There's so much in this market that is really attractive.
Equities are a great asset to capture.
Investors are very reluctant to sell today.
What people are trying to do is to trade the data points as they see them.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, the process begins.
There's a formal process that's already starting. There are a lot of great candidates. It's President Trump's decision, and it will move at his speed. I have the best job in town. I will do what President Trump wants.
NEC Director Kevin Hassett taking the early lead to become the next Fed chair. As the very first signs of tariff-fueled inflation begin to form beneath the surface, some of the biggest banks on Wall Street are shaking off recession fears. It's Bank of America up next.
That has been the unabashed takeaway so far from bank earnings, which is strength in the consumer, strength across the board, beat, which is what you said yesterday. This quote really stood out to me yesterday from JP Morgan's CFO. We continue to struggle to see signs of weakness in our customers. The consumer seems basically fine. The second thing that I find really interesting is the market's response to really good earnings is nah. And Stuart Kaiser of Citi put it this way: stocks were a victim of high expectations rather than real bad news.
Bank stocks have rallied almost 40% from the lows of April. We've come a long way. The next test for them, Bank of America later, Morgan Stanley, Goldman Sachs still to come. Here's the story that just won't die. Central bank independence and the future of Chairman Powell. Scott Bessent, the Treasury Secretary, comes on this program yesterday and says, we're not going to fire Chairman Powell. The president's asked about whether it's a fireable offence yesterday. Accusations of mismanaging the HQ renovation. Quote, I think it sort of is.
Sort of. Yes, that's sort of the implication here. Whether he's going to fire Jay Powell or not, they clearly are underway with some sort of process. That's what Scott Bessent said yesterday. Clear question for a lot of people is, what type of candidate could replace him? At this point, it does seem like Scott Bessent, it's going to be a hard person to replace, and clearly the president doesn't want to, so it seems like it's Kevin, Chris. And if it's Kevin, Chris, which Kevin is really going to make a difference, given one is particularly loyal to President Trump?
Based on the economic data so far, this tension is going to keep on building. Yesterday's a perfect example of that. Headline inflation, subdued, softer than expected. Cut interest rates. Beneath the surface, the first signs of early tariff-fueled inflation. What's the Fed going to do? Wait and see. Tension's going to build through the summer.
And the tension's already building with respect to the interpretation of yesterday's CPI. Initial read was, look, it came in softer than expected. The fifth straight read is so great. It seems like the disinflation train is well underway. And then people took a greater look at it. And that's one reason why people said that the bond market sold off, why stocks sold off yesterday, which again, okay, good luck finding that. But household appliances saw their biggest 1-month price jump going back to 1999. Core goods, when you take out cars and trucks, had the strongest monthly increase going back to February of 2023. You start looking at these figures and you start saying, what happens if this broadens out? What happens if this is stickier? And what happens if it faces off with consumer, where we're struggling to see signs of weakness?
30-year bond yield so far this morning, just north of 5% after closing at that level yesterday. Yields lower on the session by just 2 basis points. Coming up this hour, we'll catch up with George Goncalves of MUFG as market momentum begins to stall. Pierre Ferragu of New Street Research as Nvidia gets the green light from the White House, and Chris Marinac of Janney Montgomery Scott as Wall Street wraps up bank earnings. We begin this hour with stocks sliding following the first signs of tariff-fueled inflation. George Goncalves of MUFG writing, the jury is still out. How US consumers will react to any potential price increases, where a combination of substitution and less consumption of services may ultimately offset the one-off price bump. George joins us now for more. George, good morning.
Good morning.
The composition of spending is changing. Will the rate of spending change?
I think so. And I think we have to be careful. Economists, strategists were always faulted for always stripping out and taking out inflation readings. Yes, if you take out the auto move that took place in CPI, you can say that there's this big jump is troublesome, and I think we are watching it. But the auto sector, I think, is a clear example of a consumer that's struggling. There's saturation, a lot of pull forward activity. So even if we get these one-off sort of inflation moves, I think that it could be offset by substitution across different products. And the service component is a much larger piece of the puzzle. So if you have to kind of cut back on services, there's only so much disposable income to go in the U.S. And unless wages start going up, I think these are all one-off shots.
Well, for that reason then, George, the obvious question is that enough to open up a conversation on the FOMC to cut rates?
Well, that's the issue, though, because they've been using this as kind of cloud cover to kind of push back and with the mantra of waiting and seeing all this sort of totality of the data. We were one of the more dovish houses on the street. We changed our view post-NFP. In many ways, NFP stole the thunder of CPI, and we get PPI later. We'll see what happens there. There's no compelling reason to ease right now in terms of a rush for it, but the arguments have been there all along. We've had, 5 months in a row of lower inflation. We have a consumer that's very bifurcated, and of course, it's showing up in the bank earnings in different ways. But I do think that there's a large segment of the population that's struggling, and higher rates, smaller businesses will benefit from that. And we're really trying to figure out what keeps this economy going, right? And I think that lower rates would help.
Well, one reason why Fed officials have been on hold and comfortably on hold is because they don't know the actual tariff rate. Will that make a difference? The fact that they're not getting clarity on that front, they're not getting clarity from the data in terms of how you can interpret it. Yes. Do they have enough information, or are they still comfortably on hold? I
think we all are kind of waiting and seeing, right? I mean, we'll get hopefully more clarity at the end of this month. And once we know what is binding and how long it lasts, right? I mean, we've had a creeping higher weighted average tariff rate, somewhere around 9, maybe around 10%. If we're at 15% or higher, I think that it does have some sort of feed through to inflation. But then the Fed has to kind of balance that against what's truly going on in the labor market.
Do you think that inflation is the bigger concern right now, or real softening in growth?
I think that we're in this interesting inflection point where uncertainty has been lifting, especially from the policy front. We got the big, beautiful bill. We have some sort of clarity on fiscal outlook. And tariffs, of course, hopefully we get some sort of resolution soon. But it's happening at a time where the momentum is coming from different directions. Upper-end consumer still very robust and strong. Lower end, not so much. And that's been the case for about 18 to 24 months. Is it enough to kind of turn the tide where the whole economy benefits? I think the jury's out on that.
Let's push it all through the bond market. So yesterday we bought the headline, then sold the details. Yields down, yields up. 30-year yield at 5%. Does that 5% tell me more about what's happening in America or more about what's happening in Japan?
That's the question. This is a global bond market phenomenon. The back end of the curve is being driven by the oscillations in the JGB curve, what's going on in the UK. If you look at the actual dispersion and how illiquid the long-term rates have been acting, in the U.S. actually, it's quite frankly, it's actually remarkable. We have a very stable relative curve, even though rates are going up. It's really the sort of the big volatility in long-term Japanese yen rates, UK rates. It's hard to ignore.
Is that a reason to buy this, or a reason to stay away from it?
I would argue that levels are much more compelling now, and so there is value being created again. The Fed's not going to be hiking rates, so that I feel pretty good about. It's one of the more positive on the curve. And one of the other big challenges for the bond market is negative carry. We've been hoping and anticipating rate cuts for such a long time, and that the total return has given you enough juice to stay in the game. But the short-term rates, well under Fed funds, makes it challenging if the Fed doesn't start cutting, at least in 2025. They have to deliver 2 cuts, otherwise the front end has problems.
All I can say is I'm old enough to remember when people used to say that this was a stock market that was rate sensitive. And when rates would hit that 5% level on the long end, all of a sudden the red alarms would go off and people would start pressing sell, sell, sell because it would be unsustainable at that point. It seems like that's been completely turned on its head. We're now talking about the rate insensitivity of artificial intelligence and chip purchases by the hyperscalers. Is there something that's amiss here in this narrative?
No, look, I do think that, again, that we have more than one economy going on at the same time. And I think that's clearly what it's demonstrating, that some areas are much more rate sensitive than others. But you don't have to go look beyond the housing market, which is starting to really show further cracks there as well. So the more the splintering happens, where you don't have this kind of homogeneous economic sort of sustainable recovery, I think rates still do matter.
Meanwhile, one the consensus trade has been the weaker dollar consistently. I woke up to the idea that France is killing 2 holidays because they think that it could save money because it might make their population more productive. You talk about the disagreement in the European Union over whether it is a good time to incur more debt or a bad time. And I just start wondering how likely you see this sort of contrarian trade, the pain trade, of the dollar strengthening again and the euro actually seeing some weakness in the second half of the year.
Well, yeah, for the second half of the year, considering where the dollar is starting from, and given that it suffered such big losses in the beginning of the year, really going back historically, nothing really we've ever seen like that before. There is scope for the dollar to rebound here. I mean, and not to mention the passage of the big beautiful bill, the replenishment of the Treasury's general account, the draining of dollars in general that's going to happen over the course of the summer. I do think there's scope for the dollar to do better here.
Get long window repair services. There will be riots in France over cancelling vacations.
I mean, you're poking the bear. Come on. You're saying, you can't celebrate this national holiday. And then you've got the opposition coming out and saying, you're taking away our history. How dare you? I mean, this isn't going to gain popularity. How long before the prime minister faces a no confidence vote? That's
How long before that stabilizes the bond market? I think you need to keep pushing on that front. Just a final word, if we can. The Federal Reserve and the future of Chairman Powell. Can we put this story to bed? It just won't die.
Oh no! I mean, this is going to be with us. And look, it's been fast forwarded. It's now we have a larger playing field. I think it's going to be with us well throughout the fall, and we'll get, hopefully we'll know soon.
What happens if they fire him?
Like, I'm not going to speculate on that, but I do think that
I don't want you to guess if he does get fired or doesn't get fired. I want to understand what happens in markets if he gets fired.
Yeah, look. I think the markets love stability, and they like to see certainty around what has been a normal process. If the process were to go down some unconventional route, I think it's bad for the dollar and it's bad for long-term rates.
George Goncalves of MUFG. George, appreciate it. Thank you, sir. It's a story that just won't go away. Scott Bessent, the Treasury Secretary, batted it down yesterday when we caught up with him, and then it bubbled back to the surface pretty quickly when we heard from President Trump.
And this is something that you and AMH were talking about yesterday. How much is this trying to convince Jay Powell to say publicly that he's not going to stay on the committee after he steps down as Fed chair or his term is over, versus get him out and get someone in who's going to cut rates by 3 percentage points, as President Trump was saying.
Get it down to 1%.
I don't think that's going to happen. But, if Kevin Hassett comes in, does that start to become priced in as a potential possibility?
Based on our reporting from Nancy Cook here at Bloomberg, it looks like he is the early front runner. We'll see. Equity futures this morning down about 0.1% on the S&P, with an update on stories elsewhere with your Bloomberg brief. Here with us, here's Yahira Arnott. Hey, Yahira.
Hi, John. President Trump says he's likely to impose new tariffs on pharmaceuticals and semiconductors as soon as the end of the month. Trump said tariffs on drug makers would start out low and increase to a very high number after about a year. He said levies on semiconductors were less complicated to impose, but did not provide further details. Meanwhile, National Economic Council Director Kevin Hassett has emerged as the front runner to replace Fed Chair Jay Powell next year. Sources telling us here at Bloomberg the other top contender is former Fed Governor Kevin Warsh, and current Fed Governor Chris Waller is the dark horse candidate. President Trump saying Treasury Secretary Bessent is a good option, but he likes the job that he's doing. And UK inflation came in hotter than expected in June, rising to its highest level since January 2024. Headline CPI picked up to 3.6%, while food prices, they rose 4.4%. Retailers there blaming the recent price increases in payroll taxes and hikes to the minimum wage, both changes that came into effect back in April. That's your Bloomberg brief. John?
Yahira, thank you. Governor Bailey stuck between a rock and a hard place. Up next, replacing Fed Chair Jay Powell.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Up next, we'll talk about that process. We'll catch up with Terry Haynes of Pangea, plus Annmarie down in Washington, D.C. From New York, this is Bloomberg. This is how your morning is expected to shape up. Later on this morning, later this hour, earnings from Bank of America. Next hour, around 7:30 Eastern Time, you'll hear from Goldman Sachs and Morgan Stanley. Then at 8:30, another read on inflation in America. PPI is just around the corner. Equity futures so far negative by just 0.1% on the S&P. Some pretty subdued price action on the Nasdaq. reversing some of yesterday's gains. We're down 0.25% in the bond market. 2-year, 10-year, 30-year. Talked about the reaction to CPI yesterday, initially buying the headline, then selling the details. The headline softer than expected, the details showing those early few signs of tariff-fueled inflation.
Yeah, particularly in home appliances, as well as goods outside of cars and trucks. You saw some of the biggest gains, particularly in home appliances, going back to 1999. And it raises this question: does this take away demand from other areas? Because you did see a fall off, say, in airplane tickets. Or does this suggest that there is some tariff-fueled inflation in the pipeline that is going to be persistent?
It's supporting yields, that's for sure. 30-year bond yields back through 5% for the first time since June. Just holding on to those levels this morning. Yields down by a few basis points. Under surveillance this morning, replacing Fed Chair Jay Powell.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed. I have the best job in town. I will do what President Trump wants. We got a lot of great Fed candidates, and I'm confident it's going to be a robust process.
So here's the latest this morning. Sources telling us here at Bloomberg that National Economic Council Director Kevin Hassett is emerging as the front-runner to replace Fed Chair Jay Powell. Former Fed Governor Kevin Warsh is the other top candidate. Annmarie joins us now from Washington with more. Morning, Annmarie.
Good morning, John. The race is really heating up when it comes to the Fed chair. Clearly, the timeline has been brought forward than what the Treasury Secretary told me in April. He told us yesterday, formal process is underway. And our reporting is that Kevin Hassett, right now running the NEC at the White House, is telling people inside and outside the administration that he wants the job. And for more on this, we're going to bring in Terry Haynes of Pangea Policy. Terry, I thought the first rule of thumb in Washington, D.C. was that if you want a job, you don't go around telling people you want it. You actually continuously say, that's not for me. I'm happy where I am.
Well, rules are made to be broken, aren't they? Good morning. There's a lot of things going on here. One, I will say that I think we're very much at the beginning of this process and nowhere near the end. Secondly, it is necessary, apparently, for Hassett or whoever else wants the job to be able to talk clearly about the fact that they want it. I recall Trump telling Kevin Warsh a few years ago, geez, Kevin, we could have used you here. I wish I'd known that you wanted the job more, sort of thing. You really have to be clear about your ambition and be ready to audition in Trump world here, which is a little bit different than standard Washington.
Well, how complicated does that make the process, especially at some point when one of these individuals may get a hearing? Kevin Hassett used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then the Wall Street Journal had this report that he had this meeting with Trump, and around the same time, he was going on networks bashing Jay Powell and saying that he was doing the bidding of the Democrats last year, cutting rates in the lead up to the election to help Kamala Harris. Will the markets take someone like him credible, given all of that?
Well, it's there's a lot of stuff being whipped up about Powell's potential fate and Trump's potential intervention. I will say briefly four things about this. One is, you all got from Bessent yesterday a very clear indication that what Trump's doing here is working the refs. I think that was the quote. Number one. Number two, I don't think the working the refs is working very well, because not only is Powell remain where he is, but the rest of the governors don't appear to be affected by any of this as well. So that's number two. Number three, you've gotten a very clear warning, in this case from Jamie Dimon, that the markets would look very badly upon any action at the Fed. And fourthly, this whole business about the Fed being gold-plated by Powell in a renovation of the Eccles building and others, I think is frankly ridiculous. They're putting back together a 100-year-old building, and there's a couple of cost overruns. The Fed almost certainly has been very careful about what they've been doing and went through a multi-year process just to get the approvals to do it. So the idea that they're going off gold plating things today is doesn't stand scrutiny, frankly.
Well, how complicated does that make the process, especially at some point when one of these individuals may get a hearing? Kevin Hassett used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then the Wall Street Journal had this report that he used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then the Wall Street Journal had this report that he used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then the Wall Street Journal had this report that he used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then the Wall Street Journal had this report that he used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then the Wall Street Journal had this report that he used to go around telling people that his job at the NEC was to protect the independence of the Fed. And then Terry, yesterday, the Treasury Secretary also had this to say to me, John, and Lisa. Quote, there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. Right now, we are dealing with Hassett, Warsh, maybe Bessent, maybe Governor Waller. Is there a dark horse candidate, a woman that we are not talking about?
I wouldn't know, frankly, but I'd look at I'd look at a number of the different regional presidents, and I'd look at supervisory Governor Bowman as well. I mean, that's certainly a possibility. She's obviously favored by the White House, and there's two steps to this process. One step is getting nominated by the president, but the second is actually getting through Senate confirmation, and she's the one that's done that most recently.
Well, let's talk about getting Senate confirmation. You ran the Fed Greenspan hearings. Out of all of these candidates we've been discussing this morning that are out there in the press, are any of them going to have issues getting through Congress?
Well, I think Hassett's been through the process fairly recently. There is generally a predilection in the Senate to give somebody the candidate they want unless there's a real serious problem. That's happened. That happened not too long ago with Sarah Bloom Raskin, for example, who couldn't get through a Democratic Congress. So this is by no means a slam dunk. That said, too, Governor Warsh is very well known in Washington, has been for a long time. I've known Kevin for, goodness, 25 years now, I think. And, he gets wrapped on as a hawk. And I think that's misplaced, frankly, because he was reacting to a situation back during the great financial crisis where he thought that keeping interest rates low and keeping fiscal spending unending was going to harm the country. And now here we are. So what's looked at as a deficit or a problem by a lot of people, I think, is looked at actually as a calling card in the Trump White House.
Terry, very briefly, if you were a betting man on Polymarket at this moment, who would you say is going to be the next Fed chair?
Oh, I would never bet on Polymarket. And, I think today my gut is Warsh is a little bit more likely than Hassett. But as I say, we're very much at the beginning of this process.
Slightly controversial this morning, given what all the reporting is. Terry Haynes for Pangea Policy, thank you so much for your time this morning. John, Terry Haynes actually thinks that Kevin Warsh is still up there, even though a lot of reporting from Bloomberg, Wall Street Journal showing that Kevin Hassett at this moment is in front of the queue.
Annmarie, appreciate it. More from AMH later on in the programme. Let's just pick up on this story. Confirmation. Annmarie nailed it. Confirmation. Who would be credible enough to get confirmed? The market reaction to whoever it is will influence how difficult it will be to get them confirmed. And if it is someone that the market perceives as too soft, too tight to the president's whims, then this market's going to move against them pretty clearly.
And the way that looks, if you want to look at the anatomy of moving against the potential Fed nominee, it would be a dramatic steepening in the yield curve. The idea that they would cut rates in the front end, and that would unmoor inflation expectations, and potentially you could see the dollar really sink as well. If that credibility gets challenged, you are correct. There is a gut check, and it is going to be provided by the market.
And we'll see who it is and what kind of market response we get. For now, 30-year bond yields through 5%. Lots of earnings this morning. Later on, in about 20 minutes from now, we'll hear from Bank of America. Moments ago, just heard from J&J.
Yeah, and they beat expectations and they raised their full year outlook. And this part I thought was really interesting because it shows how they're dealing with policy uncertainty. They came out with this better than expected outlook, even though you just heard President Trump threaten to impose tariffs as high as 200% on drug companies if they don't shift manufacturing to the U.S. over the next year and a half. This was good news, according to the CFO of J&J, because initially the threat had been to impose tariffs in a matter of weeks or months. So the fact that there was an 18-month delay, this is all sugar and rainbows for them, and they are raising their full-year outlook.
Still waiting for those sectoral tariffs. Maybe month end we might hear something, but ultimately there's going to be some longer runway.
Yeah, and right now the visibility that you're getting is if it's not in the next couple of months, well, it's free sailing, and so far, looking pretty good. People still taking drugs.
The stock is higher in the pre-market. That's one way of putting it. Okay. Up by 1.2% in early trading. Up next, Pierre Ferragu of New Street Research on Nvidia's big win from the White House, plus Danny Berger with your morning movers, with growth concerns weighing on Applied Materials. From New York City this morning, good morning. Good is not good enough. Based on yesterday's session, JP Morgan numbers were good, not good enough. For this equity market with some high expectations apparently, decent bank numbers, not good enough. A green light to sell chips into China, good enough for the chip makers but not the index. Struggled to advance in yesterday's session, just a touch lower, down again this morning by 1/10% on the Nasdaq 100, and raising gains were lower by 1/4%. 3 hours away from the opening bell, let's turn to Danny Berger with your morning movers. Hey, Danny.
Hey, John, add to that more bad news for chip makers this morning, specifically the ones that make the equipment that makes chips. ASML in Europe had a set of earnings where they said they couldn't guarantee growth for 2026. They were planning on it, but they scrapped their guidance that they would see that. So you see their U.S. peers, Applied Materials, among them falling this morning, Texas Instruments, those types of names under pressure, down nearly 3%. A little bit of hedge fund news, according to the FT. Elliott Management, meanwhile, has taken a stake in Global Payments. The paper saying they don't know how much or what demands they are, but this payment provider, Global Payments, has been under some real pressure. It did a big acquisition in April that surprised shareholders, that sent shares tumbling. Those shares up more than 5.5%. Finally, rounding things out with Lisa, you were talking about this J&J earnings. We got that just moments ago, up 1.5%. A beat and a raise for the pharma company, despite the sectoral tariffs on the way. The CFO, Walk, saying that it was a good thing, the fact that they weren't being implemented right away, that Trump understands you can't put pharmaceutical tariff walls up right away. John, those shares up again 1.5% in the pre-market.
Hey, Danny, thank you. Just a summary of some of the names to look for going into the opening bell. More from Danny in the next hour. On our radar this morning, one of our top stories, President Donald Trump saying renovations at the Fed may give him cause to fire Fed Chair Jay Powell. Sources telling us here at Bloomberg, NEC Director Kevin Hassett is emerging as the frontrunner to replace him.
Two things. If you take a look at Polymarket, where a lot of people do bet, you can see that there is now an all-time high chance of President Trump firing Jerome Powell this year. It is currently a 24% chance, so still not a majority. I know this is sort of like, why are you doing this? Why is this relevant? The reason why it's relevant is because the race for who's going to replace him gets that much more important. The perception and the precedent is going to be really important. And why the market hasn't responded is also really important. Does that mean that all of these candidates are equally credible, the Kevins, the Chris, and the Scott?
I don't know the answer to that. I was listening to Paul Donovan of UBS earlier on this morning, speaking to Danny. I thought he made some fantastic comments that if the Federal Reserve believes that it's just a presidential puppet, they'll move against him, and you'll have a Fed chair in name only, which is something Neil Dutt has been talking about repeatedly on this show.
Which is the reason why this president and his administration wants to guarantee that Jay Powell leaves the Fed committee when his term is up as chair, because it gives them more seats so that they can pull those levers. Key question, how does President Trump avoid Powell 2.0? Remember, Powell was appointed by President Trump. And so a lot of people are saying, how do you get someone, sort of like the Supreme Court, you can secure as your dovish guy who's going to do what you want, when these are academics that tend to be much more sort of beholden to the economic data at hand.
The price of entry apparently at the moment is to trash the current Fed chair. That's the price of entry. The difficulty for other candidates, particularly those on the FOMC right now, is doing the same thing. Enter Governor Chris Waller. Enter Mickey Bowman, the governor of the Federal Reserve. What do you do at the end of this month? Do you have to stick your hand up and dissent and make a credible argument to reduce interest rates to be in the running to become the next Fed chair?
Well, that's what a lot of people have speculated, because some of the members, I'm thinking particularly Mickey Bowman has traditionally been something more of a hawk, and she has shifted to a more dovish tone. People can say, oh, she's running, and that's where the she came from. You take a step back, it becomes really difficult when there is a complicated economic argument that could be made on either side for whether they should cut or whether they should remain on hold, and there just are no definitive answers. So it's sort of this complicated political exercise at a time where the economic debate is real, and that, I think, is the hard thing to really understand.
And that debate continues with tariffs in focus, keeping this Federal Reserve on edge. President Trump saying tariffs on pharmaceuticals are likely coming by the end of the month, alongside broader levies set to begin on August 1st. Trump saying his timeline for tariffs on semiconductors is similar. This runway for pharma, though, is the important piece of the news overnight.
Well, for J&J, the idea that they've got 18 months to really bring production back to the United States is exciting. They are already investing billions of dollars to bring production back to the United States. A real question here is, what is enough to stop a negotiation? I was thinking a lot last night about what Scott Bessent said, which is he wins either way. Ultimately, if you end up with high tariffs, then you end up with bigger revenues coming into the United States through tariffs. If you have some sort of deal, well, then you get a great deal. What's to say you're going to stop then at any given deal? Why not keep going for more concessions or more revenue? Where do we understand that we're done?
There's no end point. Didn't Annmarie say at the start of the term, feature not a bug? This continues.
I just don't know how businesses really rearrange. I don't understand how they decide where to put production, and I don't understand why our trading partners would end up feeling okay with some sort of deal if it's fungible at any given time, if the goalposts move. And that's, I think, the thing that people are struggling with, and the reason why they're focused on the coalescing of other trading partners with each other and not the United States.
That's the latest on the trade front. Some valid points, as always, from Bramo. Here's a story I know that Lisa is tremendously interested in. This is not just a New York story. For the Democratic Party, this is a national story. New York City mayoral frontrunner Zohran Mamdani holding a meeting with business leaders in the city, saying he'd begin discouraging using the anti-Israel phrase globalize the intifada, but reiterating other goals, including freezing rent and hiking taxes.
So this was an hour-long meeting with more than 100 executives in New York City to discuss his plans. This is the ringing endorsement after this meeting from one of the members. It could have been a lot worse. They thought that he was very
low bar, right? Super low bar.
He was presentable, and they appreciated his flexibility in being able to converse with everybody. But everybody sort of walked away feeling the same about his proposals. It shows how high the bar is for him to actually get the endorsement of business leaders, of people who really are the bulk of the hiring and, frankly, the tax base.
Yeah, Jamie Dimon was a bit busy yesterday. He's going to have some time later on this year to maybe have a conversation, if he wants it. They're the biggest employer, one of the biggest private employers in this city. And I think we need to figure out where the banks stand on this individual.
And on a broader level, this really does raise a question. Where is the heart of the Democratic Party going to go if you have an increasing number of progressives that end up, and I use that word kind of loosely, it's sort of the poles of both parties are intersecting in an increasing way.
We'll keep tracking the story for you as we work our way towards November. Elsewhere, Nvidia and AMD are set to resume the sale of some AI chips in China after securing assurance that the US government would approve export licenses.
50% of the world's AI researchers are here in China, and there are so many innovative and dynamic companies here in China. It's really important that American companies are able to compete and serve the market here in China.
Joining us now to discuss is Bloomberg's Brendan Murray. Brendan, welcome to the programme. This is a U-turn in Washington. It's a change of policy. Brendan, what's your understanding of what drove it?
Yeah, I think basically what we have here is the Trump administration saying, look, our industries need what China has, the rare earth minerals, and what can we offer China? And it's the critical technologies that companies like Nvidia offer. So it's really a stark turnaround from the first couple of months of the Trump administration, where these chips, these advanced chips, were guarded for national security reasons and under national security sort of rationale. So we'll have to see how much further the Trump administration will go in terms of rolling back not only their own export controls, but some from the Biden administration as to whether this turn from a real hawkish stance against China becomes a lot more dovish.
I take it a step further, Brendan. I wonder for the broader negotiations, not just with China, but with other nations as well, how much flexibility there actually is. Are there national security red lines, or is this all quite negotiable?
Well, the message from the Nvidia news over the past 24 hours is that a lot of these things are negotiable, and that this will generate a lot of pushback within the White House. President Trump has some very hawkish advisors on China and other countries seen as adversaries in the trade world. So it's a really interesting development that we'll have to see how much further they go. But at the moment, the next question is, will lawmakers on Capitol Hill start to raise their eyebrows about this perceived shift that the Trump administration has made with China?
It's a good point. Brendan, appreciate your time as always. Brendan Murray out of London this morning. Pierre Ferro of New Street Research joins us now with a buy rating on Nvidia and a price target of 200. Pierre joins us now. Pierre, welcome to the programme. It's a change of policy. What kind of change does it make? What kind of difference does it make for this company?
Well, John, is it really a change of policy? When you look at the last couple of years, Nvidia has been able to ship chips in China on and off as like the export rules varied over time. So like earlier this year, we had like a very strict like tightening of the rule that created a potential shortfall for Nvidia of like $8-10 billion, over what was left of the year. And now there is an easing again of these restrictions. We had a similar situation last year and the year before last. So I would say this back and forth, you shouldn't read too much into it. I think the reality is that you have a situation with three major metrics. One is making sure we protect like the US leadership in AI. The second one is making sure we don't completely cut off the relationship with China because, as Brandon mentioned, China has very important elements into the AI race, like the rare earth materials. And the third one is that, of course, the US government, the US administration is very careful to protect the interest of US companies. And so this situation always creates a back and forth. It's good sometimes to tighten the rules to slow down like the progress of China. But at the same time, doing too much of that favors China is developing their own supply chain. And it's good to maintain the leadership of US companies globally. So it's good, as Jensen said, that they keep selling in China, and you have like the right balance to find over time. And that would be the way I look at it.
Pierre, how much is Nvidia's fate really dependent on the close relationship that Jensen Huang has with President Trump and the fact that, move over Tim Cook, he's the new tech ambassador for the United States?
Well, you could almost invert the question, how important is it for President Trump to make sure that he has like a strong ally in Jensen, like the number one, or let's say one of the number ones, tech leaders. And we know that the relationship with Elon Musk is a bit sour these days. So I think it's very important to maintain strong relationships. And yes, I think there is no real situation where the US administration wouldn't have a careful ear to the concerns of Jensen, because the success of Nvidia is what matters the most to the US maintaining their leadership in AI development. And I think that's what I read in the trip to China of Jensen and his comments and his ability, to speak before the White House on commitments from the White House tells you a lot about how much bargaining power he has in the conversation.
Quite a lot, apparently, Pierre. Quite a lot based on the experience of the last few days. Pierre Ferro there of New Street Research. Pierre, thank you, sir, as always. Just to build on your point and to pair it with Pierre's thoughts, look at his calls right now. Neutral on Apple, a buy rating on Nvidia. Now, Pierre's got his own reasons for that, but I think for a lot of people in the market, it speaks to exactly what you're talking about. Tim Cook's lost his seat. Doesn't have the same relevance or influence around this administration as he did in the president's first term.
And Pierre turned it around and said, how much does President Trump rely on Nvidia's prowess for the strength of this country and need him as much as he needs President Trump in a way that Apple doesn't, right? So how much is this sort of just sort of going with the winners and getting that accelerated by a president who wants to celebrate the biggest winner out there?
We've heard it on this program. It's a chip, so to speak, forgive the pun, in negotiations. We've seen that repeatedly over the past few months.
But you asked a great question, and I think that this really is the crucial question. Are there red lines? Are there senses that at a certain place you have compromised national security? Or is it all a negotiating chip just to get certain concessions? And what are those concessions? And I think everyone's trying to get their hands around that.
Numbers from Bank of America just breaking. We're going to read through those and we'll get back to you in just a second with an update on news elsewhere. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Johnson & Johnson shares are rising more than 1% after delivering better than expected earnings and raising its full year outlook. The company's strong second quarter comes as the pharmaceutical industry faces dual threats, the crackdown on drug pricing and tariffs. The most recent threats coming yesterday from President Trump, who said he's likely to impose new tariffs on pharmaceuticals as soon as the end of this month. Meanwhile, as you all were just talking about with Pierre, Nvidia shares did close yesterday at an all-time high after CEO Jensen Huang said he expects to soon get those U.S. licenses that will allow his company to export its H20 AI chips to China. Speaking in Beijing, Huang said he met with Chinese Vice Premier Li Hefeng, and they discussed China's openness to foreign investment. And Uber and Baidu have teamed up to roll out robo-taxis outside the U.S. The companies say Baidu's self-driving cars will hit the Uber app in Asia and the Middle East later this year, with Europe to follow soon. Other Chinese firms like WeRide and Pony AI have also struck agreements with Uber to offer robo-taxis on their platform. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. I promised you an update on Bank of America. Once again, getting used to saying this word. Yep. It's a beat. It's a beat on trading revenue and on the investment bank as well.
Yeah, what you can see right now is trading revenue coming in at $5.38 billion versus the estimate of $4.9 billion. Net interest income also coming in stronger than expected, which has been sort of a little bit more of a motley performance among the banks. $14.7 billion rounded up from $14.6 billion expectations. This is interesting. The expenses actually came in lower, the compensation expenses, and I wonder how much this is going to be a theme as they start to be more efficient with their hires. AI.
We'll get into that in a moment. Consumer delinquencies have been stabilizing. It's important for the U.S. economy. The stock is down this morning. We're down by about 0.75% in the pre-market. It's early days. Up next on the program, shrugging off recession concerns.
The inflation numbers seem to be in check, which has given more people maybe a false sense of confidence, but certainly more confidence today that the tariffs are not going to cause what many people were thinking about in April, a recession.
In just a moment, we'll get you the latest on Bank of America. We'll break things down with Shanali. Plus, we'll catch up with Chris Marinak of Janney Montgomery Scott. Live from New York City, welcome to the program. Equity futures slightly negative here. We're down by 0.05%. On the Nasdaq 100, we're down by about 0.2. Under surveillance this morning, Wall Street shrugging off recession concerns.
I think everybody's resigned themselves to the fact that the tariffs are going to stay in place and prices will be higher. But so far, even though I know the tariffs haven't worked their way through inflation, the inflation numbers seem to be in check, which has given more people maybe a false sense of confidence, but certainly more confidence today that the tariffs are not going to cause what many people were thinking about in April, a recession.
So here's the latest this morning. Numbers just dropping from Bank of America. That stock positive by 0.9%. With the details, here's Bloomberg's Shanali Bassa. Okay, Shanali.
John, you look at these numbers, they're very, very smooth across the board. You have them beating on net interest income, on returns on equity, on fixed income and equities trading, as well as the major investment banking lines. And on top of all that, if you look at the credit quality of the consumer, just incredibly strong. In fact, you look at the consumer net charge-off rate, and it's actually declined from the prior quarter. So even if you have all of these bank executives saying that we're staying cautious, we're looking at how things play out for the end of the year, the numbers themselves are very smooth when it comes to the U.S. consumer. I will say also that net interest income guidance, it's stable from prior guidance. So when you had J.P. Morgan increasing their estimates for net interest income, you have Bank of America holding steady. But remember, Bank of America coming into this quarter's report has been at a lower valuation from a price to book perspective than J.P. Morgan, which is near record highs. So you do see a pop in the stock this morning on the heels of this report. Of course, they are focusing on those Wall Street businesses, and they are performing very, very well.
40 minutes away from numbers from Goldman Sachs and Morgan Stanley. Shanali's going to stay close. Joining us now to discuss, Chris Marinak of Janney Montgomery Scott. Chris, is good enough?
Well, John, I think that there were not great beats here in terms of what you saw in the quarter. I think that smooth is the operative word. What I'm happy about is that the credit quality continues to be excellent for B of A and frankly, all the banks we've seen so far. The credit costs have been limited. The charge-offs are about the same. I think the guide is for this to continue for the second half of the year. A lot of banks are talking about loan growth getting better in the second half. We certainly had our share of uncertainty in April and May, and it has become better as we have now reaching the second half. My sense is that loan growth will get a tad better. These banks will continue to see low credit costs, and you're going to continue to see a flow through to the bottom line. So that's good for retained earnings, for capital formation. Certainly buybacks are here. We have the Fed authorizing a lot more buybacks than people thought in April. So all of that plays into the narrative right now being positive for these banks.
All right, Chris, just to turn John's question on its head, what would have been good enough? What would have been the kind of beat that would have gotten people truly excited?
Oh, I think if you had a 10-15% beat across the board, particularly on spread income, I know that the capital markets and trading side is better, and that's a win. I still think the core bank is doing okay, but not as sort of fifth gear as it could be. It's more in third gear, but it is progressing. The car is moving down the road. I think the challenge right now is, can these companies add to their growth rate to where they're taking away share from other parts of the financial ecosystem? Right now, we're not seeing that. The Fed data has been better on deposits, certainly better on loans the last couple of weeks. So it's encouraging for this theme of second half being stronger. I just think it's a question of adding, going from 55 miles an hour to 60, not necessarily 55 to 75. That, I think, is the nuance that we have to see in these companies at this point.
That's on the growth side of things, trying to ramp up to 60 miles per hour. What about on the cost saving side? And I noticed that the compensation related costs at a number of banks that have reported so far came in lighter than expected. And I keep thinking algorithmic trading, algorithmic programming, algorithmic strategies. How much are we looking at artificial intelligence that is coming out and really having real efficiency gains across the major Wall Street houses?
So I think some of that is happening, Lisa. I think that's a great point. My sense is operating leverage is positive for these companies and will continue to do so or be so. I think the challenge right now is that compensation tends to get accrued at a certain pace in the second and third quarter, and then it catches up in the fourth. So I still think your compensation question is more of a timing answer than it is some major shift with AI. I do think these companies are spending. I think they are finding ways to do more with less. I think that's been true for a while. AI is definitely going into another gear and will continue to have a bigger impact. I feel that the deposit growth of these companies is going to lead these banks to having better opportunities on the spread income, which therefore allows them to spend at a different pace than they thought, which ultimately is going to be positive for earnings.
Another leg higher this morning. The stock is up by 2%. Chris, I just want to ask this question on behalf of economists tuning in and engaging with the program. When you say the credit quality is okay, smooth, good, whatever name you want to call it, when you say that, are you saying that because the bank has done a good job or because that describes the economy? There's a read-through for the broader economy.
Well, John, I think it's both. I think the banks are doing a good job. They have a lot less leverage than they had 5 and 10 years ago. I think they're being very picky about the customers they're doing business with. And the regulators have been all over these banks the last several years, as many people know, and that's starting to get easier. I do think the read through the economy is still good. I think that the average workforce and engagement with companies and both with households is still very strong. As people are working and as companies are moving forward, even if they're not growing as much as we want them to, they are still employing a lot and doing a fair amount to continue to pay their bills. So I think that the overall ability for companies to have limited charge-offs and therefore limited credit problems is still very much intact for the banks.
Chris, 20 seconds on the clock. Top pick right now. What do you like?
I like the regional banks heading into the rest of the week, so I think Fifth Third is very interesting. Synovus SNV reports tonight. I think you still have some interesting earnings and trends coming out on Truist and Regions as you get to the rest of the week. First Citizens, FCNCA is still next week, but that is still picking up business from the old Silicon Valley carcass. So I think there are some opportunities in the regionals that we haven't seen fully fleshed out.
Chris, 20 seconds. Bang on. Appreciate it. Chris Marinak of Janney Montgomery Scott. Chris, thank you, sir. That last point, the earlier point near the end there, about whether it's banks being picky or whether it just tells you something about the broader consumer. Could have some debate about that.
Especially because you can see subprime auto loan delinquencies have been rising really significantly over the past few quarters.
Up next on the program, we'll catch up with Kara Murphy of Kestra Investment Management, former senior White House trade advisor Kellyanne Shaw, Devin Ryan of Citizens, and the former World Bank president David Malpass.
The tariffs are not going to cause what many people were thinking about in April, a recession.
I don't think it's inappropriate for the Fed to be starting to consider lowering policy rates here.
I fully agree with the Fed's forecast that inflation is going to go up.
They don't have to promise a broad swath of rate cuts. In fact, they're not doing that.
This is not an equity market or a credit market that is screaming at you to cut interest rates immediately.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures just about unchanged on the S&P 500, following very mild losses in yesterday's session. The Nasdaq down by 0.2%. Over the next hour, more earnings for you from Goldman Sachs, from Morgan Stanley. Looking for those numbers around 7:30 Eastern Time. 60 minutes after that, another read on inflation in America. This time, it's U.S. PPI.
After yesterday's inflation read left everybody with a story of their own making. If they wanted to say that there was disinflation in the system, well, check out the headline levels. You got it. If you wanted to say that there was tariff-related inflation, well, check out some goods, particularly household appliances. You've got a record there in terms of an increase when it comes to the month-over-month gain, which leaves everybody pretty much in the same place, looking at earnings for some sort of guide. And even those, you could raise the same questions about what the actual tell is from a broader economic picture.
Well, let's talk about the earnings so far from the big banks on Wall Street. Later this hour, numbers from Goldman, from Morgan Stanley. Decent idea based on the volatility of the second quarter and the first month of that second quarter. The trading numbers are going to be pretty decent. Okay. What a read on the U.S. economy. Bank of America out just moments ago. Based on their customers, and we can get into the nuances around that, but based on their customers, credit quality is okay.
And based on J.P. Morgan's customers, they say we struggle to see any signs of weakness. That was the CFO. We heard something similar across all of the banks. This is a great question, John. The idea of, is this the customer base of these banks that has been increasingly prime, increasingly higher quality, or is this a broader read on the credit quality of the classic and average American? I'm looking right now, and how do you square these delinquency rates, these loan loss reserves coming in, this really positive commentary on the consumer, with the fact that subprime auto loan delinquencies have risen to their highest level since June of 2020 at the peak of the pandemic? How do you square the sort of tale of two worlds that is going on under the hood?
Lizanne Sodders of Charles Schwab was on the program recently, and she mentioned a phrase that I haven't heard since really the pandemic. Heard it now and again, but the K-shaped economy. We heard that repeatedly in the pandemic. We've seen it again and again in this economy over the last several years.
And averages aren't catching it. The question is, it hasn't really mattered in terms of, it matters from a humanitarian standpoint, but it hasn't mattered in terms of the overall trajectory continuing to be strong. Is it starting to matter? And that's where I think that the composition of spending starts to really change. If goods are starting to get more expensive, if the household basic items are, do people pull back on services in a more material way? Where suddenly airline prices are coming in and you start to see maybe people saying, maybe I'm not going to go overseas, maybe I'm just going to go to the next state?
That's the right question. If the composition of spending changes, does the rate of spending change? And does that open the door for more of a conversation for lower interest rates at the Federal Reserve? That, for me, is the conversation that's got to take place at the end of this month. Now, it's getting more interested now because we've got a race to be the next Fed chair. And I just wonder if you get that dissent on the FOMC from some of the individuals seemingly in the running to replace Chairman Powell.
I just think it's a shame. You know, I have to say, and I'll give my opinion here. I think it's a shame that it's getting so complicated to have a debate that's already complicated about where we are in the economy with how much is politically influenced. And I think that that's actually sort of damaging to the actual intellectual debate of, we don't know what this economy is really going to do. And ultimately, we need to have a vigorous, non-influenced debate about what the best policy is going forward.
They never know. The question is, do you have enough evidence on your side to wait or to make a move and go early?
Stop being so.
You never know for sure.
I know, you never know for sure. But right now, there's a really legitimate debate. And where do you lean in on? I think that people would have more of a sense of conviction if it was coming from a place of pure economic analysis rather than, hi guys, I could be a good candidate too.
It's fair to say that one is doing that, Waller, and the other is not. Hassett, maybe?
Yeah, but the truth is, Chris Waller would be considered a very credible candidate probably by this market. I wonder about Kevin Hassett.
So do I.
Yeah.
So do I.
I mean, if you see somebody nominated and you see a steeper yield curve, and you see a dollar that weakens dramatically, well, there's your vote.
I'd love to catch up with him, but I know he's often engaged with another network. And maybe we can fix that sometime, Kevin, if you watch it. I've tried. Equity futures right now in the S&P, just about unchanged. Coming up this hour, Cara Murphy of Kestra Investment Management on why she's overweight equities. Devin Ryan of Citizens reacting to another round of big bank earnings. And the former World Bank president, David Malpass, on the process to select the next Fed chair. We begin this hour with stocks steady as the latest data leaves the Fed in wait-and-see mode. Cara Murphy of Kestra Investment Management writing, we are modestly overweight equities with lower exposure to mega caps in favour of mid-cap, a tilt towards non-US and a focus on earnings growth. Cara joins us now for more. Cara, good morning.
Good morning.
Let's get to that last slide. Earnings growth. Where are you seeing it? Where's it coming from?
So I think we definitely had a pause heading into second quarter, and that's sort of what we're going to be chewing through over the next couple of weeks as we make our way through earnings season. But what is so important and what is usually important in earnings season is getting the view of the second half. And I think what we're finding is that CEOs are coming in a little bit bolder about what the second half looks like. They're able to sort of like take that slower growth in the second quarter, but then see a real reacceleration into the second half of the year.
Where are they getting clarity on policy from?
I don't think they are.
I'm not seeing it. Lisa's not seeing it. Are you seeing it?
I think what they're able to do, and this is where time is all of our friend, right? When tariffs were first introduced in early April, it was this huge change, and people didn't really understand even what the implications were for their supply chains. Over the last couple of months, many CEOs have been able to sharpen their pencils, understand where those implications are, sometimes diversify their supply chain so that they're less sort of beholden to, let's say, China, where, you know, that's sort of been ground zero for tariffs, and also be able to forecast different scenarios. So again, this doesn't say that policy isn't an impact. I think policy uncertainty is still a really big challenge, but being able to have that time to work through it really makes it much easier to be able to manage through.
Is the air getting very rare for some of these stocks? And John was asking for the totality of the morning, saying, you know, not good enough. And that seems to be the read through from bank stocks. Is that a sort of wider spread phenomenon throughout the stock market?
So when we came into earlier this year, one of the main risks that we saw were high valuations in a very concentrated market. With the rebound that we've had more recently, we still have those same exact risks. And so that's really a big reason why we're leaning a little bit more into mid caps, a little bit more into non-US. So yes, I think that's a challenge, but it's a challenge for certain names. And then you mentioned financials. I think that's a really interesting area where these names got some really nice lift recently. So I think some of the maybe like lackluster reaction to the earnings is more a reflection of what the stocks have done recently. And I think importantly, as we look through those bank earnings, what we see is pretty decent underlying economic growth. And I think, again, that augurs well for second half earnings growth in general.
You know, it feels very volatile. There's been a lot of volatility on a headline level. When you actually look at the MOVE index, which is implied volatility in treasury yields, it's pretty low. When you take a look at the average VIX, it's come down pretty significantly. Do you just sort of sit on your hands, decide what you like, buy it, go on vacation?
Well, I like to describe the first half of the year as the Rip Van Winkle market, right? If you had gone to bed on January 1st, woken up at the end of June, you'd be like, I did a great job. Like, I feel really good.
I wish I had.
Right? Don't we all wish?
I've been on vacation
on many levels. But carry on.
Right, but the challenge is that we all lived through that. The good news is that experience helped us sort of live through what we're going through now. And I think over the weekend, we saw this new introduction of tariffs, and the market just didn't react, right? The market has reacted less and less with every new tariff announcement because, and this is important, because the assumption is that the Trump administration is not going to accept a recession in exchange for its trade agenda. If that breaks, then I think we have a very different market. But as long as that holds, the market's going to be like, okay, you can tinker at you as you will, but we're not going to face a recession, so all is good.
How are you justifying the tilt to non-US at the moment?
So this has been a challenge for US investors for a very long time. And we talk with a lot of investors who are, you know, frustrated with owning anything outside the S&P 500. And over the years, you've seen, again, higher and higher concentration in US stocks around the world, higher and higher valuation differentials between those. But it's been largely justified because of stronger growth in the U.S. I think as we're moving from a very unipolar free trade world to a multipolar world where maybe U.S. is a little bit less dominant, I think we start to see capital flows outside of the U.S. And then on top of that, you have maybe a little bit of a narrowing of the differential in growth rates, a little bit of a narrowing of that valuation differential.
What is the European growth story that I can get excited about? What is it?
So it's like, it's a little bit better than what it was before. And that's what's important. So there is a lot of infrastructure spending that's happening. And so it's just that incremental growth. It's not necessarily that it's going to take off going forward, but it's priced for a slower growth environment than what I think we see in the next couple of years.
The growth story is fewer holidays. That's what we're learning
for us.
for us, sure. Yeah, but in France, right, the idea that you're going to take 2 holidays out. I just wonder, you know, what this sort of debt management and sort of when debt is too much discussion, whether that's really going to come into play with bond vigilantes that seem to be picking on Germany, even though Germany's debt to GDP ratio is really good. It's not as though they're particularly overly indebted, and yet you've seen yields in the long end climb there too.
I think if there's anybody who needs the finger pointed at that has a debt problem, it's the U.S. And as I think about one of the largest challenges that the U.S. faces and a really intractable problem is the amount of debt that we have. And let's be clear, it is Republicans and Democrats who have contributed to this. This is not a political issue. This is an American issue. We like to spend money. And so far, the debt markets have given us a pass, right? For many, many years, we had really, really low interest rates. Now that's changed, and that's why the equation really has to change. But I don't think we're going to tackle it anytime soon.
Cara, it's good to see you. Thanks for dropping by.
Thank you.
Cara Murphy there of Kestra Investment Management. If you are just joining us, futures doing okay. Equities down by not even 0.1%. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Arnold. Hey, Yahara.
Hi, John. NATO Secretary General Mark Rutte warned China, India, and Brazil they could face secondary U.S. sanctions if Russia refuses to negotiate a peace deal with Ukraine. The three countries have continued buying Russian oil and petroleum products since the start of the war. Rutte urged the leaders of those countries to pressure Putin to engage in talks. Meanwhile, Apple TV picked up 81 Emmy nominations. That's the most ever for the 6-year-old studio, with its original show Severance landing 27 nods. Warner Brothers Discovery won the most nominations overall this year with 142 for The Penguin, White Lotus, among others. The Emmy Awards are scheduled for September 14th. And in sports, the MLB All-Star Game was one to remember after a late American League comeback. The National League jumped out to a 6-0 lead before the AL rallied to tie the game in the 9th inning. Instead of going to extras, the game was decided by a home run swing-off, which the NL won thanks to the Phillies' Kyle Schwarber, who won MVP. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next 30 minutes. Up next on the program, more tariffs on deck.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
Some better news for pharma this morning. Up next, we'll catch up with the former senior White House trade advisor, Kellyanne Shaw. The first month of Q2 was absolutely wild. We're expecting to see that reflected in some of the trading numbers from the big banks, and so far we have. Next up is Goldman Sachs and Morgan Stanley, about 15 minutes away. Then after that, after we get those numbers, we'll get PPI at 8:30 Eastern Time. Just your day ahead there for the next few hours. Equity futures on the S&P negative by 0.1%. On the Nasdaq 100, we're lower by 0.2%. Under surveillance this morning, more tariffs on deck.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
It's the latest this morning. President Trump saying tariffs on pharmaceuticals are likely coming by the end of the month, alongside broader levies set to begin on August 1st. Trump saying his timeline for tariffs on semiconductors is similar. Joining us now from Washington is Annmarie. Morning, Annmarie.
Good morning, John. Looks like we are now going to have back-to-back deadlines. The sectoral tariffs, whether it's pharmaceuticals or it's semiconductors, that's at the end of the month. And then, of course, August 1st is the new deadline when it comes to those country-by-country specific tariff rates. To really try to understand exactly what's going on in the world of trade coming out of the White House, we're pleased to be joined now by Kellyanne Shaw. She's, of course, a former senior White House trade negotiator under Trump's first administration. Kellyanne, walk us through potentially how these pharmaceutical sectoral tariffs will work. The president's saying he's going to start very low, try to engage the pharmaceutical sector to domicile in the United States, bring their manufacturing centers in the United States, and then if they don't listen, maybe he'll ratchet up the pressure. Is it going to work?
Good morning, Annmarie. Now, this is a very different sectoral approach than we've seen the president take with steel, aluminum, autos, copper, where those tariff rates have really gone on right away and at a very high level. But I think the pharmaceutical industry is very different from some of these other commoditized sectors in that it's not just onshoring various aspects of the supply chain, but it's also going through that regulatory FDA approval. And these processes take years to carry out. So I think it is helpful that the president has said there'll be a transition period. I think companies have asked pretty explicitly for that. But what we don't know yet are the details of how this transition will work, what those tariff rates will be, and if tariffs will actually apply starting day one, or if that's really something that we'll see kick in at year 1, year 2, year 3, or so on and so forth. So we're not quite sure yet how this will work, but I do think that the pharmaceutical industry is at least relieved to see some sort of transition period.
So it sounds like there's a dialogue happening within this industry and USTR and the Commerce Department. But is a year enough for them to really move all this manufacturing back to the United States?
Well, just to put it in context, even going through the FDA approval of some of these new manufacturing facilities and production lines can take 7 or 8 years. So a year alone is not going to be enough to onshore the entire production of the pharmaceutical industry and all the drugs and medicines that we need for Americans. But what we don't know is exactly the scope of the measure either. We're not sure whether the president is targeting specific pharmaceutical products, whether it's going to apply to everything, whether tariffs will be higher with respect to products that have, for example, Chinese API versus API from other places. We just don't know enough about how this measure will work to really assess its efficacy. But that said, the president has been clear that he wants tariffs on some of these products. And so I am expecting to see an announcement related to tariffs on or around August 1st.
He also talked about the semiconductors will come out around the same time. What's that rate going to look like?
Yeah, a lot of the same questions, and not just on the chips, but also on some of the substrates, wafers, and the components of chips and the derivative products. So we're not quite sure what those rates will be, whether it will cover all 3 of those product types, whether they'll be focused on chips from China, whether TSMC and chips from Taiwan will be caught up in this, or whether our iPhones and laptops will be tariffed at the end of the day. So a lot of open questions there that the administration is actively debating. There is, just like in the case of the pharmaceutical sector, an active dialogue with industry happening right now. But I do think it's clear that both of these sectoral tariffs and sectoral investigations are on track for tariffs, along with everything else, as you mentioned, on August 1st. So I'm watching these very, very closely to see how the administration decides to apply this, whether they take a narrow approach or they really, just like we did in the reciprocal tariff case, take a sledgehammer.
Do you think that when it comes to the semiconductors, there's going to be carve-outs, especially if it's going to hit people's everyday products like iPhones and laptops?
Well, there's the potential for that. And we're seeing this in the pharmaceutical sector, again, because the president is expressing a willingness to have this transition period. It's possible that we could see some sort of transition period with the semiconductors, that chip investigation as well, because these industries are very, very complex. They're not commoditized. They're highly linked up supply chains. But the president, on the other hand, has also said he wants iPhones out of China, that he wants them produced in the United States. And so there is some appeal from a political perspective for him to at least threaten tariffs on some of these derivative products to try to move some of that manufacturing and frankly to disincentivize the use of Chinese chips in some of our finished products that come to the United States. So that's the active debate right now. My guess is the administration is in its final hours of trying to decide what measures to put before the president, but it's clear that he's leaning towards this idea of a tariff on both these product lines. And so the recommendations that go before him, I have no doubt will have tariffs as an option.
He wants to get manufacturing and products out of China. At the same time, what we saw yesterday was the Treasury Secretary acknowledge that that H20 Nvidia chip, which this administration had an export control on back in April, was used as part of the, quote, mosaic of trade talks. So which is it? Do they care about national security, or do they really want to get deals done and maybe they are going to give some concessions to Beijing?
Yeah, I thought that comment was really interesting yesterday. And I went back and looked at my list of the countermeasures on the US side that I thought might get traded as part of this China deal. And I had the H20 originally on my list, but then the administration officials had gone and confirmed that H20 was not going to be part of the China trade talks. There was an interview with Director Hassett where he mentioned that that was an advanced semiconductor measure and it wouldn't be traded away. And of course, now we see the administration saying that it in fact was. So there is some confusion with respect to how broad these measures were and what counted as a countermeasure and what counted more as the national security tool. And I think that is a very delicate balance. And one of the reasons why bringing export controls into the China talks really did conflate and confuse some of these issues, and I think made it a bit more complicated. But when it comes to these 232 sectoral tariffs, this is about ensuring production in the United States and among allied nations so that at a time of conflict, a time of war, a time of supply chain disruption, the United States is not overly reliant not only on China, but frankly on anyone else. And so I think that's what you're seeing the administration work through. But at the same time, we need these products now for national security purposes. And so imposing tariffs, imposing import limitations also poses some challenges from a national security perspective. So these are not easy issues. I think you're seeing the fact that there's no clear answer on either pharma or semis just goes to show how complicated this is.
Right. And the U.S., of course, was dealt a rude awakening during the pandemic about how these critical materials and products were outsourced when we really needed a lot of them here. I want to end on what's going on with Brussels. We have the European Commission's top trade negotiator headed to Washington today. He's going to be sitting down with Secretary Lutnick as well as Ambassador Greer. Do you think Brussels and Washington to get to some sort of framework before August 1st?
Yeah, I am relatively optimistic, and I think you're hearing positive signals from the EU side as well. I do continue to think that there are huge gaps between the way Brussels and Washington look at the world when it comes to trade and how much progress ultimately both sides can make in terms of a trade deal. But there is a tremendous amount of political will from the very top to try to get something done, and I think that that goes a long way. Now, the president has squeezed the EU with this threat of tariffs on August 1st. I think they are taking it in stride, meaning they push back their own retaliation. They're trying to get to the table, to be productive, to strike a deal. So I remain relatively optimistic, but we'll have to see how far they get.
Kellyanne Shaw, former senior White House trade advisor, thank you so much for joining us this morning. And Jonathan, just that last point on the European Union, we have reporting this morning from our colleagues out of Europe that France is working on building support around the EU to try to go after the most aggressive retaliatory measures if they don't get to some sort of framework or agreement before August 1st.
Annmarie, thank you on the latest. Love listening to Kellyanne every single time. Made some really strong points on pharma. We should develop and manufacture pharma domestically. National security. Can't argue with it. Strong argument. On Nvidia and the chips here, I wonder, have we negotiated on a national security issue, or have we just conceded the policy didn't work? And I have some sympathy with the latter over the former.
It seemed like Jensen Huang had an argument that is increasingly gaining clout with the administration, which is if we're not present in terms of the global infrastructure, then China will take over and will win with the digital Belt and Road.
Also, bank earnings this morning. The numbers from Goldman just drop in. We'll break this down in detail in just a moment, but this is what you call a beat. A big beat from Goldman Sachs. Look at this. For fixed sale and trading revenue, $3.47 billion, the estimate $3.26. Equities, $4.3, the estimate $3.72.
Yeah, you could see pretty much across the board. Net interest income came in stronger than expected at $3.1 billion versus $2.4. Loans also stronger than expected. The headcount went down. I'm watching that. I want to see if headcount comes down and if you end up with efficiency really picking up.
Stock is higher in the pre-market, higher by 0.8%. Up next, we'll catch up with Devin Ryan of Citizens with numbers not just from Goldman, but also from Morgan Stanley. Plus, Danny Berger with your morning movers. Equity futures just about unchanged. The S&P 500 going nowhere. The Nasdaq just a little bit lower, down by 0.2%. Lots of bank earnings this morning from Morgan Stanley and Goldman Sachs, and a lot of beats. With the latest, here's Shonali Basak. Hey, Shonali.
We are looking at trading revenue just flying through the roof, John. When you look at Goldman Sachs' revenue, you can see why the stock is up 1.5%. This is not only the highest equities trading in Goldman's history, we see it as the largest equities trading haul in Wall Street history. So just a stunning beat there. They brought in more than $1 billion more in equity trading revenue than JP Morgan. And you also see Goldman Sachs beating on advisory revenue, bringing in more than $1 billion there as well. Just really stunning numbers in a market that a lot of people were worried about. You might have remembered before. An executive from Goldman does say that their pipeline in investment banking does remain healthy. When you look at Morgan Stanley as well, remember this is a big competition in the trading business. They also beat in FICC and equities trading, but came in below Goldman Sachs in that equities trading number. For Morgan Stanley, for wealth management, they beat on pre-tax margins as well as on revenue. Compensation expenses came in higher than expected. I want to speak to what Lisa was talking about here. There is competition for talent as deals come back and as, of course, trading comes in so strong at these banks. At Goldman, yes, headcount did decline about 2%, but compensation expenses rose, which means that these efforts these banks have made to become more efficient gives them a little bit more money to be spending per banker, per trader. Remember, the talent war is still running hot and heavy. And of course, they're making those investments, as Lisa was talking about, in artificial intelligence and technology as well.
Shonali, you only get April 2nd once. So we've had the trading boom. I've got all of that. Show me the second half. This from Bank of America just moments ago. Feeling good about investment banking in the second half of 25. Do you see enough out there right now beyond Bank of America, Goldman, Morgan Stanley to feel good about the second half?
Remember that the numbers themselves lag what announced deal activity is. These banks often make money when deals close. And if you look at the numbers from Bloomberg, they're pretty good so far. You have double-digit percentage rises. Remember, last year, investment banking, John, was a total dog. So this year, the activity is starting to come back. Remember, some of it is a little frothy, too. A lot of the activity that we're seeing when it comes to IPO markets, there's SPACs coming back, convertible offerings coming back, a lot of crypto. But these banks are also looking at a private equity industry that has been saddled with assets for many, many years, and investors are demanding their money back. So there is activity to be had, and it's got to be better than last year. On the trading boom, to your point, these banks are lending so much money to the buy side. Hedge funds have performed generally well. They have that dry powder to spend if they want to.
Morgan Stanley numbers also coming out, and I would love just a touch on them because they did beat across the board when it came to equities trading, as well as FICC, as well as wealth management. I thought it was interesting, though, that provisions for credit losses across the board have gone down relative to expectations, except at Morgan Stanley. Is there anything you can read into how Morgan Stanley was just slightly different from the others?
Definitely. Remember that the provisions are much, much smaller than those big Main Street banks, JP Morgan and Bank of America. So the number itself, they can swallow. It's not so big of a deal. It's not going to break into their margins in this massive way. But at the same time, this is what I've been saying for the last 2 days. When provisions are going down, is it a sign that the consumer is doing well or that the bank is just watching how much risk they're taking on? At those big consumer banks, you hear all that caution. You hear Jamie Dimon saying the consumer is just fine. You even hear David Solomon talking about how they're very focused on risk management here. Morgan Stanley has been trying to grow their lending book. So a little bit more risk means taking on more clients.
Hey, Shonali, thank you. Shonali Basak there, breaking down the banks. We asked the same question. Is it execution or the economy? Probably a little bit of both, but it's a question worth asking.
Yeah, are they being cautious in terms of who they lend to? Are they taking on a little more risk? And is that leading to some of the beats that you're seeing at some of these places? Either way, how much can we actually read into the broader economy versus these banks specifically that, as we saw from Goldman Sachs, is reaching record levels in terms of profitability?
Trading revenue boom over at Goldman Sachs. That name is up by 1% in the pre-market. Let's stick with the banks. Devin Ryan of Citizens downgrading Goldman Sachs to market perform ahead of the results, writing, quote, "The bar is now much higher for another leg up." Devin joins us now for more. Devin, we've come a long way. We've had a big rally for most of these banks coming into this earnings season. What do you make of what you've heard so far?
Yeah, hey, Jonathan. Good quarter. We thought it would be a good quarter. We were quite a bit above the street, but they still beat our numbers. And so what we're seeing is tariffs were actually pretty good for trading. And so we'll have to see now that kind of the tariff volatility has died down a little bit, what the back half of the year looks like for trading. But then on the other side, investment banking activity is really reaccelerating. Remember in April, we were questioning whether this is a pause or a break for investment banking. Right now, it looked like it was clearly a pause, and now all that activity that was kind of put on the back burner is now moving to the front burner. So we're seeing a pretty substantial reacceleration. Announced M&A volumes are tracking up 20% year over year, even with losing a couple months. Number of IPOs in the U.S. are up 80%. So we feel really good. Goldman, we put a buy on it at $200 back in 2020. So now it's $700. The bar's higher, and that was really what the call was.
Do you see enough in the numbers this morning, at least, to question the downgrade, Devin, or are you sticking with the thesis?
Yeah, we're sticking with the thesis. Listen, it's a great company, and our thesis was, they're taking market share, and people don't really realize it. And then also they're growing their asset management business, particularly in alternatives, and people don't appreciate how much assets they're raising. And so I felt like we had a differentiated call, and now we've become more consensus. So we're just looking for opportunities where we still have differentiated calls. But listen, you had a great quarter, and I actually think the outlook, again, trading is going to be a little bit of a question mark into the back half of the year because the tariff volatility did help. But Goldman Sachs and Morgan Stanley, too, they're gaining market share. So you have the market backdrop, which volatility helps. Then on top of that, both firms are actually taking market share in trading. Goldman's really leaning in on their prime brokerage business. So we feel really good about the tone of the business. We want to reevaluate on the stocks here and consolidate some of these gains we've seen.
We've heard a pretty steady story across all the bank earnings about how steady the consumer is, how businesses are gaining confidence. And there's a feeling that everything is chugging along with a greater degree of certainty than on April 2nd. I'm just wondering if this is a broader economic kind of read through, as John's been asking all morning, or if this is something that really indicates the banks have been much more cautious with who they lend to, the creditworthiness of all of their clients.
Yeah, I think what we're seeing and what we're hearing is that, there's obviously always tail risks here. And I think people are cautious to make sure that there's a lot of macro events that are occurring. Tariffs, there's still uncertainty there. There's geopolitical risks. And so I think there's obviously a sense of, cautiousness just to be careful that you're not getting yourself in trouble. But overall, the trends that I think banks are seeing right now and that we're talking to both investors and CEOs about is that things are good out there. The consumer is in still a very good spot. The low end of the consumer is being more affected by inflation, and there's maybe a little bit more challenges there. But more broadly, the consumer is in a great spot. And then companies, as you see in investment banking activity, are leaning back in. So they're going back on offense. M&A volumes are picking up. Companies are feeling good about raising capital. Their stock prices are at all-time highs. So I think there's a really good sense of kind of optimism in the market right now from both corporates and consumers, and that's what I think we're going to hear from virtually all banks through earnings season here.
There's really a question about whether this is a pivot point, where some of these banks that have been treated as though they're utilities for the past 10 years can become more growthy, especially if they start to get deregulated to the point where they can compete more aggressively with private asset managers. Do you see that as a likelihood this year?
Well, if you listen to JP Morgan's call yesterday, a lot of questions on fintech, a lot of questions on stablecoins and tokenization. So I think the conversation is evolving a little bit. Banks are still, I think, obviously, steadier types of business models, and they're not going to take a lot of risk. But this world of kind of less regulation, I think, is starting to creep in, and I think it's going to be a tailwind for banks over the next couple of years. And then on top of that, I think another catalyst here is consolidation. You're starting to see a little bit of bank mergers. It's going to be in the kind of the small, mid-sized banks, but I think that's going to be very valuation enhancing. And I'd look to the back half of this year to start to see some of that. And I think that will be a catalyst for the broader group, something that we really haven't seen over the past 4 years.
So, Devin, just drill down on some of that. As you mentioned earlier, some of these ideas became very consensus, Goldman being one of them, and it certainly performed. If you were looking for something non-consensus, something a little bit different in this sector, maybe the broader industry group, what would you look for?
Yeah, so we're kind of, some of the large cap names I think are pretty well owned right now. It's kind of the index plays. So we're looking at some of our mid cap coverage. So a company like Stifel, which kind of looks like Morgan Stanley in terms of wealth management and institutional exposure, but much more reasonable valuation at kind of 11 times our exit 2026 earnings level. But still get some of those really good exposures. Then they also have pretty good leverage to bank M&A with their KBW business. So kind of that theme that we just talked about. So that would be one. A small cap advisory boutique called Perella Weinberg is a name we really like. So we want to be selective here just after these really big runs. And then I'd also, regional banks, as I just mentioned, with bank consolidation and deregulation. I think that can have a bigger impact on their business models as well. So broadly, that is a kind of an index play.
Hey, Devon, appreciate it. Thanks for giving us some time. Busy morning for you, I know. Devon Ryan there of Citizens. The final point there, similar to what we heard from Chris Marinac in a previous hour. As for Goldman, the move we've seen, 52% off the lows of April, up more than 20% for the year so far, and up again so far this morning.
And frankly, the numbers are justifying it. They just had a record trading haul when it came to their equities trading business, and you see across the board positivity. Question is, how high has that bar gone? And do you start to see some of those regionals really start to outperform in a more meaningful way? 1
hour and 50 minutes away from the opening bell. Let's get you some morning moves, including the financials. With more is Danny Berger. Hey, Danny.
Hey, John. Just want to put them all together so you can get a kind of clean read of where we're trading. It's both Bank of America and Goldman that are gaining in the pre-market. Both of them strong loans, strong trading, especially for Goldman Sachs, as you've been talking about. The one laggard this morning is Morgan Stanley, despite some beats there. Not good enough, though. The other set of earnings we had this morning, about an hour, a little bit more than that ago, was Johnson & Johnson, a beat and a raise for the pharma company. 2.3% is where it's headed higher in the pre-market trade. That's despite what's likely to come in terms of sectoral tariffs for pharma. That's despite some of the cost breakdown, some of the cost pressures from the federal government for drug pricing. But the CFO telling Bloomberg that the tariffs are actually a good thing because they will come in 18 months, giving them enough time, which they have been doing, ramping up some of the production in the U.S. Finally, the crypto stocks, a good day for them. Legislation is making its way through the House after a stablecoin passed in the Senate. There were some conservative holdouts, but the president said yesterday that he talked to members of the House and was able to get them on board. So you can see a lot of those stocks gaining at least 1.5% this morning, John.
Hey, Danny, thank you. Appreciate the update. That stablecoin push is becoming a bigger and bigger feature of the debt market, fixed income, T-bills, and demand for treasuries.
Yeah, could they issue stablecoins as one way of diversifying the deficit? And that's actually something that they're talking about increasingly. And that's the reason why you're hearing people like Jamie Dimon yesterday asked about stablecoins in a meaningful way. Yeah, I don't know. I mean, do you think this is going to be actually something that we're going to see?
I think we're seeing it, aren't we?
Well, not stablecoin issuance instead
No, but
of
we're
treasuries.
seeing the demand for T-bills because of the demand for stable coins. And ultimately, if you loosen up the regulation and encourage some of that movement, that's the direction of travel.
Yeah, I keep thinking about, and yes, okay. And the reason why I seem distracted is I'm still thinking about what Shonali said, the fact that headcount in Goldman Sachs went down, but that overall compensation went up. I'm sorry, I'm distracted by this because I keep thinking about
You're changing topics, just to keep
I'm just
up.
changing
Okay,
topics.
all right.
I'm sorry. I mean, stable coins are fascinating.
I was waiting for you to link the two.
No, I'm not going to link the two.
Okay,
Maybe
all
it's just that there are people who are investigating stable coins and technological prowess. I'm not going to
try.
put that
All
in.
right, shall I move on?
No, I mean, I just think that's really interesting. People will get paid more, but there'll be fewer of them. And what this does to the ecosystem of jobs. I just think that's really interesting.
Thanks for sharing your thoughts. No, I'm with you. I'm with you.
Anytime. Do you want me to keep going with
No,
coins?
I'm going to go now.
Okay.
Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Shares of Nvidia closed at an all-time high yesterday after CEO Jensen Huang said he expects to soon start getting those U.S. licenses allowing Nvidia to export its H20 chips to China. Speaking in Beijing, Huang said he met with Chinese Vice Premier He Lifeng, and they discussed China's openness to foreign investment. Meanwhile, ASML shares are falling after the chip equipment maker struck a cautious tone on its outlook for next year. That's because despite a positive performance, the company says tariffs are muddying the picture for forward guidance. Its CFO did say that lifting chip controls on China would boost demand. And the maker of the ultra-popular Labubu dolls, Pop Mart, says it expects first-half profit to jump at least 350%, fueled by global demand for its hit collectibles. Celebrities like Rihanna and superfans have pushed the plush monster dolls into international stardom, helping the toy maker's valuation exceed $40 billion. I think they're ugly. That's your Bloomberg Brief. John?
Yeah, Ira, thank you. I must be getting old. I've got no idea what they are.
Really?
Zero.
Labubu-boo-boo-boo-boos?
No idea.
Honestly, I can't even say it. Labubu's by Labubu.
Anne-Marie's lighting up the group chat right now.
Oh, my God.
Don't admit that. Apparently, I shouldn't admit that I don't know what they are. I don't know what they are.
They're popular dolls,
Okay.
and a lot of celebrities have them, and I don't really get it. I don't really get it.
Yeah,
I don't really sleep with dolls. I'm just saying.
I mean, I
Let's move on.
don't know if we needed that clarification. Up next. Okay. Up next, the search for the new Fed chair.
There's a formal process that's already starting. There are a lot of great candidates. And we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Here in New York City, we'll catch up with the former World Bank President, David Malpass. Equity futures on the S&P just about negative by not even 0.1%. On the Nasdaq 100, we're down by 0.2%. One of our main stories over the last 24 hours under surveillance this morning, the search for the new Fed chair.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed. I have the best job in town. I will do what President Trump wants. We got a lot of great Fed candidates, and I'm confident it's going to be a robust process.
So here's the latest. The NEC director, Kevin Hassett, taking an early lead to become the next Fed chair. Sources telling us here at Bloomberg that both Hassett and former Fed Governor Kevin Warsh are the top two contenders. Joining us now to discuss AMH. Annmarie, we're not going to talk about Doles. We're talking about the future of the Federal Reserve. Why is Kevin Hassett front of the line?
Well, right now, this is an individual that's very close to the president, and clearly he's had a lot of face time with the president. And you've seen a clear change of tone from this individual who used to go around and say his job as running the NSC was to make sure that he would talk about the independence and really encourage the independence of the Federal Reserve. The Treasury Secretary would call it the jewel box of monetary policy. And now, at the same time that he's having these meetings, according to the Wall Street Journal, he is also going out on television and talking to people and bashing Jay Powell and saying that he was political last year, cutting rates into the election. So this is something that likely the president likes to hear. This is someone that he would be willing to cut rates, and he's telling people inside and outside the administration that he would like the job. The president also said yesterday, which I thought was really interesting, that Scott Bessent is still an option, but he's not his top option because he liked the job he's doing at Treasury. And we've been talking about that really for weeks. If the president was going to pull the Treasury Secretary to move him over to the Fed, this would create almost another problem and a huge hole for the president. I also think it's noticeable. We should remember there could be a dark horse candidate. The Treasury Secretary yesterday said his or her nomination. Would someone like Mickey Bowman potentially get the nod? This is the start of the formal process.
Annmarie, thank you. That process has begun. Joining us around the table, a potential candidate, the former World Bank President, David Malpass. David, good morning.
Good morning, John.
Would you like to be considered?
Of course. So it's a huge job and really important to the Trump changeover that's going on in the world, saving the country. But it means a lot of change at the Fed. I think they've been making many mistakes, and we can enumerate them and correct them. And that will mean more growth, and especially more growth in median income. If the Fed were allowing more small business growth, there'd be more jobs that are new jobs for people across the country, not just in urban areas.
Well, let's get into some of the details. Walk us through a couple of the examples where you think they've made mistakes and the remedies for them, how you'd correct course.
You know, I didn't like QE. Think about QE, that the Fed in its wisdom is going to go buy bonds. So how did that work out? They've lost $1 trillion. They'll lose much more than that before they're done with the losses on the bonds. In addition to that, remember, they've paid out in interest constantly since 2009. They've paid $1.3 trillion of taxpayer money to banks and to money market funds. That's the source of funding that they have to buy the bonds. So this has been the worst hedge trade in history. So that's a big mistake. It's also led to inflation because the Fed really allowed a merger of fiscal policy and central banking or monetary policy by buying bonds as the government was really jacking up the deficit.
Well, you're out of the running already, because I have to say, isn't that exactly what the president would like to see?
What would he like?
President Donald Trump would very much like to see monetary policy and fiscal policy very well aligned.
No, I think he wants to see them both improved and is already doing that. The reconciliation bill improves fiscal policy, and the separation, what we need is lower interest rates, and you can't do that if you've got the Fed carrying the load of all this fiscal deficit that Congress is generating.
So in the near term, as a candidate yourself, what do you do as a potential new Fed chair to the composition of the Fed and the approach that you think right-sizes it?
I think really important is people to see the flaws of the inflation targeting model. I've been writing about this literally since the 80s, that if you target inflation as your goal, it's backward looking and it doesn't comprehend all of the prices within the economy. It's just a flawed indicator, but that is the basis of how the Fed sets interest rates. So one of the things is you switch and you say the dual mandate is to have price stability. That's very different from CPI inflation, which wavers around and gives you false signals. That's what's happening right now. So you need lower interest rates because of the strength of the U.S. economy. I think that's something that I understand a lot from working all over the world and in Wall Street, in financial markets, that the U.S. is this giant power and people want to invest in the U.S. even at lower interest rates.
Okay, this is a fascinating argument. It's one that President Trump has talked about, the idea that it should be almost a credit rating of the United States that backs what our interest rates should be. So like a Microsoft or an Apple, the borrowing costs should be very low. People are pegging it to inflation and they're pegging it to growth. I'm just wondering, the market doesn't see it that way, right? We're not there yet. So at this point, how potentially perilous is this discussion at a time where the market associates lower interest rates with faster inflation and frankly higher borrowing costs for the United States?
The market's inbred with the Fed. And so as long as the Fed is the sheriff of the land, the market is going to say, oh, we operate on that model. But as you change to a model that makes more sense, one that's based on the growth in credit of the U.S. has something to say about what the interest rates are that we should pay, that can be a smooth, safe transition. But it has to be explained. Markets adjust. Think of what's going on tariffs now. There was a giant panic that didn't materialize. The change in the Fed system is as big as the change that we need in the trading system, and it will work better for growth and especially better for the forgotten man. The median income has been doing very poorly over these maybe 20 years, and so if you have a system that's very focused on defending the dollar as the global reserve currency, and then people flooding into dollars, that's actually supportive of markets.
Seconds left. Have you spoken to the president about the role?
I don't want to talk about the process. What I really want people to focus on is the models that need to be changed.
Okay.
We can have a much faster growth economy with different Fed models, and it can be done with the confidence that is absolutely necessary.
We can have a longer conversation about that next time, sir. Appreciate your time.
Thanks.
And best of luck. The former World Bank president, David Malpass. Up next, Phil Camporelli of JP Morgan Asset Management, Stephen Trent of Citi, Yelena Shuletseva of the Conference Board, and Ian Lincoln of BMO.
Sentiment is no longer bearish. We're now in a bullish position.
There's so much in this market that is really attractive.
Equities are a great asset to capture.
Investors are very reluctant to sell today.
What people are trying to do is to trade the data points as they see them.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
A trading boom supporting earnings on Wall Street. The big banks delivering big time. Equity futures so far this morning just about unchanged. Your scores look like this on the S&P 500. On the Nasdaq 100, down by about 0.1%. Bank earnings on Wall Street behind us now. In front of us, 8:30 Eastern Time. Another read on U.S. inflation. This time, it's U.S. PPI.
Yeah, let's see if the narrative shifts at all. Yesterday, the narrative was something like this. Oh, it's disinflation. 5 straight quarters of declining CPI month over month. And then, oh, actually, it's inflationary because the tariffs showed up when it came to certain goods pricing, in particular household goods. Do you see a similar read-through in PPI? And then do we focus on the beige book this afternoon? Happy beige book, John.
I'm going to move on from the beige book. No, it's important. I'm going to focus on retail sales next. And this is why, really, we've been talking about it all morning. If the composition of spending is starting to shift, people are paying up for goods and then leaning away from services to afford that, does the rate of spending change? So we know about the price of goods. Now we need to understand about the spending, how consumers are really pushing out those earnings and what they're going to do in the next few months.
Yeah, are consumers just being smart? They're going sort of whack-a-mole where prices are best and they go there. And then, frankly, they kind of take a step back in terms of spending in other areas. But overall, the pool of money stays the same. Or is it going to cause people to retrench more fully? This is a complicated story. And that's the reason why everybody has a different interpretation of it. Right now, we hear from the banks consumers are strong, creditworthiness is good. And then we hear that on the lower end, consumers are pushing back. Retail sales will show that in a more holistic way, as well as an ongoing slew of earnings that go beyond the banks to what exactly retailers, what exactly airlines are going to show.
So, of course, I will look at the beige book. Of course.
Of course. Happy Beige Book Wednesday. Come on, let's make this a thing.
This meeting at the end of this month could be quite controversial. I think it's going to be very interesting. It's going to be quite spicy. Might actually get some dissent at the FOMC.
And there are going to be questions about how politically motivated these dissents will be. And I think that that is somewhat unfortunate because there is a very real economic discussion around whether there should be a more active discussion about cutting rates at a time where you do see signs of disinflation and you do see signs of weakness on the margins. That said, I just wonder how much having Fed Chair Jay Powell on the chopping block, get chopped, is going to be really an increasing discussion. And you've got the potential candidates raising their hands.
Was that your impersonation of the president?
I don't know what that was. I don't know what that was.
That's what it sounded
Let's just
like.
Move on.
Okay, I'm happy to move on. Chris Waller. I think it's unfair for Governor Chris Waller. Of course he wants to be the Fed chair. Why wouldn't he want to be the Fed chair? He's a Fed governor.
Of course.
Makes perfect sense. He's also delivering quite a credible argument to reduce interest rates, which many economists on Wall Street agree with.
That's, I think, the problem here, is that there is a credible argument, and how much does it get undermined by the ongoing politicization of what's going on with the Fed? The bigger question that I think is increasing, and I see all of the webinars coming through, what happens to markets if President Trump fires Jay Powell? Who is the credible candidate, and what does the market response look like if there is someone selected who they believe will be an actor of President Trump and will cut rates unilaterally regardless of the economic backdrop?
What matters is who replaces him. Many people on this program have said that. And to get to a confirmation hearing, you need to make sure you don't upset this market too much. Because if this market pushes back, as we've said on this program, this market will vote and vote and vote and vote long before the Senate even has a hearing.
And the vote that would be negative, just to sort of give you an anatomy of a lack of credibility of potential Fed nominees, would be a significant dollar weakening and a significant yield curve steepening. And that's what a lot of people are concerned about, the idea that cutting rates now leads to faster inflation later.
Which might make it harder to cut interest rates down the road.
Yeah,
so
there you go.
Here we are. Equity futures right now in the S&P 500 just about unchanged. Coming up this hour, Phil Camporelli of JP Morgan Asset Management on its overweight allocation to equities. Stephen Strent of Citi Research looking ahead to earnings from United Airlines, and Yelena Shuletseva of the Conference Board on signs of a clear tariff pass-through. We begin this hour with stock steady as investors await more inflation data. Phil Camporelli of JP Morgan Asset Management writing, uncertainty is moving to certainty, which will allow the market to continue to grind higher. We believe the S&P 500 has a reasonable shot to hit 6,500 by the end of the year. Phil joins us now for more. Phil, good morning.
Good morning.
Where are you seeing certainty, sir, and what issues?
Yeah, I think the three big kind of areas and clouds of uncertainty this year. The first was, of course, tariffs on April 2nd. The second was Federal Reserve kind of independence, which you guys have been talking about the past couple of minutes. And then the third piece is, okay, what do we do about economic data and inflation based on tariffs in conjunction with fiscal policy? And you put all those three things together, and I think that's where our kind of fundamental story is growing. So when you say an overweight to equities, we try to line it up three ways: the fundamental story, the technical story, and the valuation story. And from the fundamental side, listen, we've dropped our recession probability from a coin flip in April, 50%, all the way down to about 20%. And I think a large part of that has to do with an effective tariff rate that we think is going to be between 10 and 15%, somewhere there. But at the same time, this big, beautiful bill, right, is introducing some really important dynamics around, which you've probably talked about, the permanent R&D expense story for AI companies. And then the other piece is deregulation. So the deregulation story around financials. And I think when you're looking at these financial reports over the past couple of days and the commentary, these M&A deals are happening. It's almost like chaos and uncertainty is just a given, and it's not holding people back. And the cyclical story can continue to remain. That's what we've heard from a couple of banks.
Part of the reason why there's a lot to unpack there. I want to start with the one big beautiful bill. People talk about how this gives people certainty. There will be a greater degree of investment in 2026. Can you just look past this year entirely and head to 2026 and just go la 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 uncertainty? I'm just going to move past it.
Yeah, and Lisa, I think that there's a little bit. We're going to put that to the test this quarter, because I think this quarter is when you might see, and we started to see a little bit in goods inflation yesterday. Maybe we'll see it in PPI, later this hour. We're going to start to put that to the test of whether this inflation story that can percolate and maybe a slowdown in growth can be looked past into next year. And I think that's what the market is telling us. And the Federal Reserve is also telling us that if the labor market even budges a little bit, that they'd be ready to ease. But Lisa, I don't think there's any reason for them to ease right now, right? And I think that's what is playing out in the market. The 10-year note should be at 4.5% if the Federal Reserve maybe goes once this year. And that's where we're heading.
Let's get into it. You said that the other potential risk was a loss of Fed independence.
Yes.
That hasn't exactly gone away. I mean, it seems like if anything, it's kind of got heated up.
Yeah.
So can you dismiss that as something that isn't a huge risk?
Yeah, there's two people that hate when stocks go down and bonds go down. Me and Treasury Secretary Bessent, right? So I think that Lisa, is a trip to 5% on the 10-year note in a heartbeat. And you mentioned it, right? Dollar weakness along with a rise in rates. If there's any sniff that the market is saying that the Federal Reserve is the puppet of the administration. And, back in April when President Trump called Jay Powell a major loser would have been okay. Major loser was a step over the line. And rates shot up. That's I think when the administration pivoted to more of what Treasury Secretary Bessent was saying in February, that the administration wants lower rates. So we believe, never assign a zero probability to any event, but a very low probability that Jay Powell does not make it to May of 2026. And then we'll see who the new chair of the Fed is at that point.
You mentioned the weaker dollar, something Lisa's been talking about all morning for good reason. Typically, we wouldn't talk about how to balance your dollar exposure because it's what you wanted.
Yeah.
It's what you demanded. You wanted exposure to dollar assets, including the exposure to the underlying currency.
Yeah.
How are you approaching that situation now?
Yeah, so we as you know, we're global allocators, right? And that was like the worst thing you could possibly be other than 2017 in the past few years, because not only was the U.S. market doing exceptionally well, but you also had dollar dominance. And what we've really appreciated this year is that this has been the worst 6-month run for the U.S. dollar to start a year than at any point since 1973. Let's just start there. It's been 50 years since we've seen the dollar weaken this much. So for us, that's a major story in how we're allocating assets, that we can make a bet on non-U.S. stocks, right? And that's part of our overweight to equities, with the belief that the U.S. dollar will continue to normalize. I don't think U.S. exceptionalism is going away. I think that's like internet fodder. I think U.S. exceptionalism is normalizing to the point where the U.S. dollar at this point can be a tailwind for investors in the U.S. investing abroad. Why? Because you have growth converging with the rest of the world. You have interest rate policy in the U.S. converging with the rest of the world, and you have fiscal policy. I've been talking about this story for a while. The fact that we have not only the U.S. but other countries doing fiscal stimulus, John, is particularly Germany, is a big story.
Let's stay on the dollar weakness.
Yeah.
Shouldn't that also be a tailwind for international earnings?
Yeah.
For US-based companies?
Yeah.
Isn't that an argument to get long the earnings story of the multinationals based here in America?
Yeah, and that's part of our thesis as well, John, is that PE sitting at 22 times sounds expensive, but if you get the tailwind from dollar weakness and bringing those earnings back to the U.S., that's an important thing. And then the AI story. I think the last two trades that we did in equities were to communication services and to technology. So we're still 2 handles lower on PEs on the Mag 6. So we're just excluding Tesla for a second on Mag 6 than we were before DeepSeek. It's hard to imagine DeepSeek was 2025. That seems like 2023 at this point. But we're still 2 handles below. So we still have a valuation upside potential for those Mag 6 companies. And those Mag 6 companies do not need a rate cut from the Federal Reserve, which is also an important theme.
So the 3 prongs, valuations, technicals
and valuations,
and fundamentals.
Yeah.
Valuations, definitely not good enough in terms of any kind of earnings beat that we can see. I mean, Goldman Sachs just had a record quarter when it came to equities trading revenue, and the shares are up percent. Okay, they're throwing them a bone. How much does that threaten and raise the bar so significantly high for all of the high flyers pretty much across the U.S. equity market?
Yeah, I'm with you, Lisa. That's what 22 times is you better show us something really special. And the onus now is on the earnings and growth story in the next couple of quarters to kind of substantiate those 22 times earnings. But again, if I could just differentiate a little bit, the 494, their PEs are at year-to-date highs. But the discount of the premium that the Mag 6 have over those 494 is the cheapest since 2017. And we're still 2 handles below where we were pre-DeepSeek. And again, if you go back to that big, beautiful bill, R&D, expense, and deregulation, I think those 2 things can really help the AI story, which is where we're finding kind of value in the U.S. market. And then outside of the U.S., the global diversification is really working for us.
Are you finding yourself focused more on 26 and much less on 25?
The only thing about 25 that's left is the Federal Reserve kind of direction of travel. I think that is going to be a really important theme for investors. But at the end of the day, if the Federal Reserve is not moving policy because growth is moving back towards trend and maybe inflation is staying a little sticky, we can buy into the nominal growth story. Those cuts are just being priced out. So there's 4 cuts priced in. If those 4 cuts continue to happen at some point, that's okay. However, if inflation were to really unravel and those 4 cuts become 3 or 2 cuts, that's when the market pulls back by 5 to 10%.
If someone was listening to this and thinking to themselves, I thought that there were still tariff negotiations going on. I thought that maybe Europe was going to get something like a 30% tariff rate. It could even go up if they put retaliation on it, and that potentially could hit things. Are you just saying ignore that? It's going to be noise? Are you saying that it's likely that there will be some sort of agreement that won't be overly punitive where it's mutually assured destruction?
Yeah, so it's a combination of we're not going back to April 2nd, which was the 30% effective tariff rate. So we're believing somewhere between 12 and 15% effective tariff rate. But Lisa, the big piece of new news was the big, beautiful bill, right? So if you get that kind of story that I was talking about deregulation and R&D, that is offsetting the tariff costs almost perfectly. So that, I think, is the big new piece of information that investors are dealing with that allows them to look past just the tariff story.
Phil, it's good to see you.
Great. Good to
Thanks for dropping by.
All right.
Thank you, sir. Phil Camporelli there of JP Morgan Asset Management. Equities just turning positive, just by an inch, by 0.02% on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. Big bank earnings wrapping up with Bank of America, Goldman Sachs, and Morgan Stanley all reporting. Goldman shares are higher by 1% after the bank posted a Wall Street record on its equity trading numbers. Meanwhile, Morgan Stanley also beat estimates on trading but fell short on advisory fees. And Bank of America shares are rising 0.8%, with traders there posting a record second quarter. Meanwhile, Congress is a step closer to clawing back billions of dollars in funds for public broadcasting and foreign aid. The Senate voted to advance $9.4 billion in cuts, which would cancel funds for PBS and NPR. If the Senate approves the package of cuts today, it will go to the House, which plans to vote before a Friday deadline. And New York City mayoral frontrunner Zohran Mamdani met with about 100 business leaders from the Partnership for New York City. At the meeting, he said he would discourage the use of the anti-Israel phrase, globalize the Intifada, but stuck firm on his other policy goals, including freezing rent and hiking taxes on wealthy New Yorkers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, the Morning Calls Plus, Stephen Trent of Citi Research looking ahead to earnings from United. That's next. This is Bloomberg.
there were not great beats here in terms of what you saw in the quarter. I think that smooth is the operative word. I think the challenge right now is, can these companies add to their growth rate to where they're taking away share from other parts of the financial ecosystem? Right now, we're not seeing that. I just think it's a question of adding, going from 55 miles an hour to 60, not necessarily 55 to 75. That, I think, is the nuance that we have to see in these companies at this point.
There's another problem for some of these companies, that good right now just doesn't seem to be good enough. We've had a major rally, some decent numbers, and this is the price action, positive by just 0.5% on Bank of America. A record trading call for Goldman on Wall Street for the equity trading business, and we're higher. You said it, Lisa, higher by only 1%.
And it just shows how high the bar already was coming into this. Is this just a banking story? Is this a story for all the high flyers, including big tech, when they report earnings? Nvidia, of course, reports earnings like next year for the second quarter, but
gotta fix that.
It's true. I mean, come on, it's a quarter.
Bring it forward. I know.
Get with the program, guys.
Jensen, fix it. Do whatever you want. Do whatever you want.
He does.
Equity futures on the S&P 500, positive by not even 0.1%. That's some of the price action out there this morning. Here are the morning calls. First up, Wells Fargo raising its price target on JP Morgan to 325, believing its second quarter results support higher estimates. That stock is up by 0.1%. Your second call from Needham raising its price target on Alphabet to 210, citing its strategic position and YouTube's strength in the TV space. And finally, JP Morgan raising its price target on Boeing to 230, saying strong deliveries support the company's second quarter. Sticking with aviation, United Airlines reporting second quarter results after the closing bell. Investors looking for impacts of air traffic control issues and flight cancellations at the carrier's Newark hub. Joining us now, Stephen Trent of Citi Research. Stephen, welcome to the program, my friend. What are you looking for a little bit later?
Oh, thanks so much for having me. Appreciate that. So we do think in United Airlines' case, after the close, they'll report $3.78 a share. We remain constructive on the investment case, but I do think there could be some noise in 2Q around what happened in Newark Airport.
Just on a more macro level, there's a question about whether the consumer is still being really discerning about traveling, particularly the U.S. consumer. What are you expecting them to say about pricing power at a time when you've seen airline tickets go down, you've seen consumers domestically push back, and a lot of them have reduced capacity dramatically?
Yeah, great question. So I think that it's difficult to lump all consumers into one basket. And Delta Airlines set the tone for this. What we continue to see is upper-end consumer demand remains very good. And probably there's even a little more certainty on that demand today versus a few weeks ago, because we now at least have some color on taxation. When we think about domestic main cabin, that's been weak for everybody. And I don't expect any big rebound in that side of the fence anytime soon. But you have names like United, Delta, American that are in the right verticals, international long haul, co-branded card remuneration. These are the kind of things that are supporting earnings for the network carriers.
So, Stephen, if just taking a step back, are you saying that some of the biggest airline carriers are more credit card companies that have these sort of peripheral businesses where they shepherd people around in the skies, and that's why they can do really well, even if some of the others that are mainly just airline companies are going to struggle?
Yeah, look, the co-branded card programs are really important. And when one thinks about the level of remuneration from those programs, they are a very big deal. They are a big reason why you've seen this group de-risk its earnings stream. So if you look at today versus 2019, this is one of the reasons why the network carriers have seen such a big increase in their earnings wallet share versus discount carriers. And not to say that discount carriers don't have co-branded card programs. They do, but the economics on those programs and the amount of wealth, let's say, in Delta's frequent flyer pool versus a discount carrier's frequent flyer pool, that's a very hard comparison for the discount airline.
When you take a step back also with the macro story, there's been a big question about how the increasing tensions between the U.S. and some of its trading partners, I'm thinking of Canada, has been sort of a poster child of this, but also Europeans, whether inbound travel has really gone down and stayed lower. We've seen that at least from Canada, not as much from other places. What do you see about international travel? How much are you seeing that come back, and how much is it just outbound rather than other people maybe taking advantage of the fact that the dollar is a bit weaker?
Yeah, absolutely. So if you look at the U.S. network carriers, 80-some-odd% of international point of sale is here in the United States. So that's not to say that there's zero impact on international travel or zero risk. Certainly there are. You have some European cities, for example, that have had protests about overflow of tourism. That, at least in part, is somewhat of a risk for what we see on the international side. I think Air Canada is a somewhat different case. And what they've done, yes, you have seen less Canadian traffic flow inbound in the United States, but Air Canada seems to have mitigated a lot of that with its Sixth Freedom travel through its Canadian hubs.
Stephen Trent of City Research there. Stephen, thank you. Looking forward to your conversation tomorrow. Scott Kirby, United Airlines CEO.
You know, I think that some of these CEOs have the best view into exactly what the consumer is doing and how companies are adjusting and adapting. And they can't necessarily look past 2025 to 2026 just yet. Real questions here, yes, about the Newark hub and how much they're able to recover from that. But the bigger macro story of how much they have to continue with reduced capacity in order to keep prices sort of stable at a time of dropping demand. Or do they see the same thing that Ed Bastian sees, which is a very stable backdrop with a resuming consumer demand to go around, get some sun, take a vacation, drink a beer?
I'm sold. I'm buying. Great, I'm in.
I know, 100%.
What are we doing?
I know, exactly. Although I wonder where they're going.
To your point, there is a difference between what Delta has told us and what we saw in the CPI numbers yesterday. CPI numbers didn't spell out a great story for this industry.
They've showed continued declines in airline prices, and we saw them discount them significantly earlier this year. We did hear from Delta that the prices are firming up, and on the margins, that's what people expect over at United. I guess the supply-demand dynamic, how much capacity are you willing to take offline in order to get prices at a certain level? They could fill as many airplanes as they want for a price. What is that price they're targeting, and how much do they see consumers absorbing going forward? It's kind of one of the keys to that inflation puzzle that we're about to get another piece of just shortly.
The United Airlines CEO sitting down with Lisa tomorrow morning. Look out for that conversation. As Lisa pointed out, PPI just around the corner. As we start to form a better idea of what PCE will look like, we'll get those details in just a moment. We'll catch up with Elena Shuletseva of the Conference Board. The up and about 60 minutes away, seconds away from another read on US inflation. This time it's PPI. The scores into that data point look like this. Equity futures just about positive on the S&P 500, down a tenth on the Nasdaq. In the bond market, 2-year, 10-year, 30-year, check out 30s. That yield sitting right on top of 5%. 5% this morning on 10s, 446, on 2s, 394. With the data, here's Mike McKee. Good morning, Mike.
Good morning, John. It's coming in lower than anticipated at this point, with final demand headline at 0.0, ex-food and energy 0.0, and ex-food, energy, and trade 0.0. So a remarkable kind of performance there. Year over year, we're at 2.3%. That's a significant drop from 2.6%. For core, it's 2.6%, down from 3%. And for food, energy, and trade X, it's 2.5%, down from 2.7%. So this is a number you can bet that the White House will be touting as evidence that there are no tariff pressures. We'll have to see where the actual prices came in here. Final demand goods did rise 0.3%, while services declined by by 0.1%. And this being a service economy, that probably had a lot to do with it. I'll check out the details as you check out the markets.
Thank you, Mike. Appreciate it. Yesterday, a downside surprise. Core inflation softer for a fifth consecutive month, softer than expected. PPI this morning, a downside surprise, unlocking some small gains in the equity market. The S&P 500 up by 0.1%. In the bond market, yields coming in just a little bit at the front end of the curve by almost a basis point, down about 2 on 10s, and just below that line of the sand, that 5% line. On a 30-year this morning, we're down by 2 basis points at 4.99. So, Lisa, yesterday, the headline was comforting somewhat. The details were nuanced. I wonder if it's a repeat this morning on PPI.
And maybe that's the reason why you're not getting as much of a knee-jerk reaction as you did yesterday, because if you dig into this, people are now saying core PCE. What are the components that go into that key metric that the Fed looks at? And if you take a look yesterday, especially the non-autos and trucks, you take a look at that, you could see that there still is inflationary pressure. How much housing contributes to that? Do we get a similar type of analysis from the PPI report as well?
Mike McKee, I asked this question yesterday. I'll repeat it with regards to PPI. How much comfort can we take from this morning's print?
Well, it's a little bit unusual given the drops that we saw. So it is something that needs to be looked at in depth. And we'll see, as you've been talking about, what it means for the PCE. But it does take some of the, I guess I would say, pressure off Mickey Bowman and Chris Waller, because you've got a number that could suggest that the Fed could be cutting rates sometime soon. But it really is going to depend on the detailed breakdown of where the prices did go up and where the prices did go down. If they went down, if it is because we saw a drop in services, even though goods went up, then that's not going to be as comforting because the tariffs are on goods, not services.
Mike McKee with the latest. Mike, I'll come back to you in a second. With us around the table, Yelena Shuletseva of the Conference Board. Yelena, good morning. Good to see you. Good morning. So we've only got so much data. We've got CPI, we've got PPI. What are we learning so far about how the costs of tariffs is being distributed across this economy?
Well, tariffs costs are definitely passing through into the consumer prices. We saw that in the CPI report. Today, I need to look at the details of PPI, but it looks like goods prices are also rising. So this is going to be a story that will stay with us for the summer months. What I will be looking at during the summer months is not only whether this is broadening into a broader kind of range of categories of goods, but whether it will also be continuously rising for the categories of goods that we saw a big increase in. And that will actually tell me if it's like inflation that is going to stay with us or if it's a one-time rise in prices.
You know, this is so difficult, Yelena. I'm looking at the revisions from the prior month, from May, and you can see all of those were revised upward. You can see that pretty much across the board, almost commensurate with how much they were reduced relative to expectations this month. How difficult is it to pinpoint at a time when the data is actively moving and there's so many moving pieces and components that are all kind of beaten to their own drum?
There are a lot of revisions. There are revisions in the payrolls data. There are revisions in the price data. I will be looking at what it means for the PCE deflator that will be released on the 31st of the month. And I guess the Fed will have a very good read of what June inflation looks like when they go into the meeting later this month.
How much is Trump 1.0 a good sort of template for how inflation will be felt from tariffs this time around? And I say this because you look at the washing machine example. Yes, washing machines became more expensive, but people bought fewer of them. We see household appliances, once again, prices increasing pretty significantly. Do you expect, and how important is it to see whether people are buying fewer of them in retail sales in some of the earnings reports?
We absolutely expect that. So, and not only with goods, but also with services. If prices of goods are going up, you will consume fewer services. And this is what I think we see in the price data. And I think that's what we're going to see in retail sales. It's actually difficult just by looking at retail sales to kind of gauge what happens to the services sector. But restaurant spending is in retail sales report. Another difficulty about looking at economics data these days is that retail sales are reported in nominal terms. So how much, if it comes in strong, does it mean it's about the prices or is it about the real spending of the consumer. I think consumers will slow down their spending just simply because they will become more cautious. They are telling us that in our consumer confidence report. And I think that higher prices will prevent them from splurging on discretionary services going into the second half of the year.
Will it prevent the Fed from cutting?
Absolutely. This upcoming meeting, I think we will see a cut in December, but the Fed will obviously need to see a clearer picture. And looking at the details of those CPI reports and PPI reports would help.
Let's get to the details. Mike McKee has more. Hey, Mike.
John, it looks like a lot of this is in the services side. There were huge drops in airline-related categories, including passenger carrying. That was down 2.7%. So that put a lot of pressure on services. When you look at the goods side, electronics actually rose significantly, and other goods such as energy also rose. So we do have some pressure on the goods side, as Yelena was talking about. On the services side, it is weak. Had we not been in a tariff economy, you would be looking at this as really good news because service prices had been driving inflation for a long time. And now it has come down, and we're kind of where the Fed wanted to be.
Mike, the Fed's in a tough spot. As you know, they're facing a lot of pressure to reduce interest rates. Yesterday, the Treasury Secretary said the president's not thinking about firing the Fed chair, and yet the speculation continues. Mike, what's your reaction to that this morning?
Well, we talked about this at the Rocky Mountain Economic Summit last night at the dinner. The problem for Trump is that if he tries to fire Jay Powell has already said, and the Fed has already said, they will sue, they will go to court. And so it's not going to be an easy or quick decision, especially since the Supreme Court has already said Powell doesn't fit in the same category as the Merit Systems Protection Board and the others that the president was allowed to fire. So I'm not sure how much he gets out of this. And if anything were to happen in the near term, then that really guarantees, I tell you, that the Fed would not do anything on rates in July. And it may push September off the board because the Fed isn't going to sit back and just do what the president wants because he has a tantrum.
Mike, question from a Bloomberg subscriber. Are you in a bunker or a fancy multi-million-dollar cabin?
Somewhere in between, I would say. If there's bunkers like this, I could live here. But this is a hotel lodge out in Victor, Idaho, the big city of the eastern part of Idaho.
It's not bad, is it?
It still has a fireplace going. I love it.
Beautiful. Mike, thank you, sir.
Well, I know you guys like that, so I do. I put the fire. I don't
just
need
for
it,
us,
but
not
it
for
looks
you.
nice.
No,
Yeah.
for us. We appreciate it. Thanks
for you.
The sacrifice that Mike McKee makes for us.
Yeah, when's he going to come back from the woods? He's out there with the
Been there
bears.
a week.
Yeah, bear bells on.
Yeah.
Fed policy.
Good for him.
Okay.
Yelena's still with us. Yelena, goods versus services. Goods versus services. What does that tell you about how weak this economy is right now? That we're seeing that kind of dynamic take place.
That's essentially robbing Peter to pay Paul kind of thing, right? The story of two tales. I think we are going to see goods inflation rising over the summer months, and that would weaken consumer. So I think the GDP report that is coming out at the end of the month would show us weakening in final demand to domestic purchases. This is the metric that Chair Powell always cites. Even though the headline GDP number will rise probably substantially on a decline in imports. So I think the consumer is really weakening, and we will see that going into the second half. Just because, these price pressures are adding to other things like the student loans not available to a broader set of consumers anymore. It's getting harder to get that loan. Delinquencies are rising. So there are other things that are affecting consumer, not just prices.
How can I pair what you just said with some of the commentary we're hearing out of the banks? We're struggling to find weakness. We think the consumer is increasingly solid. Companies have an increasing amount of conviction. From Ed Bastian of Delta, we see a lot of stabilizing. We see a pretty stable backdrop. How do you square that type of commentary with what you just prescribed going forward of a weakening consumer?
I find it really difficult myself, but I think a couple of things. One is probably is not as bad as it was So we were expecting, some people were expecting a recession even, right? And it's not on the radar anymore. So consumers are kind of in a solid pace, but it hasn't happened yet. So I think we're just at the beginning of these price increases that would weigh on consumer spending going forward. So it's simply about present versus future and what happens going forward.
Do you see a difference, because I know you track this at the conference board, a difference between the confidence levels of consumers and the confidence levels of business leaders?
Absolutely.
Is there a difference right now?
I think both are kind of pointing to this kind of a slowdown, nascent slowdown going forward. So consumers are feeling okay at present, but there's like this weakening going forward happening. So is businesses, but they're not falling off a cliff. They're not like predicting layoffs or anything like that. So that's kind of the idea that we see weakening going into the second half, but not a recession.
Yelena, it's good to see you. Thanks for dropping by. Yelena Shurateva there of the conference board on the latest economic data. PPI, at least for this month, softer than expected. Likewise on CPI yesterday. Yes, the details are nuanced and they might be concerning for many of you. But the fact of the matter is there's some better news at the headline level and certainly not what people were looking for back on April 2nd.
And so if you want to make the disinflation argument, well, here you have something that can give you fodder. If you want to say inflation still could be present, well, here's this. There was the upward revision to the May data that basically offsets any decline relative to expectations for the prior reading, the June reading. And you've got airline tickets that went down in price significantly, and that was part of the contribution to this downside surprise. Is that set to pick up? Listen to the commentary, hear what some of these executives have to say. These are the types of things people are going to be parsing through.
How do you make a broad-based inflation argument at this point when to satisfy good prices at these levels, consumers have to give up something else on services? Isn't that just pointing to the idea the economy is not strong enough and that for inflation to pick up for that prolonged period of spiraling inflation, just don't see it in the data in the last 24 hours?
It depends on wages. I can make an argument about anything, but with conviction, absolutely nothing right now.
Agreed.
And I think that that's where we're at in terms of inflation as well.
Is the economy strong enough to give this Federal Reserve the luxury of waiting? That's the debate they'll have at the end of this month. With an update on stories elsewhere with your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. Sticking on the Fed, National Economic Council Director Kevin Hassett has emerged as the frontrunner to replace Fed Chair Jay Powell next year. Sources telling us here at Bloomberg the other top contender is former Fed Governor Kevin Warsh, and current Fed Governor Chris Waller is the dark horse candidate. President Trump saying Treasury Secretary Bessent is a good option, but he likes the job he's currently doing. Meanwhile, Speaker Mike Johnson is calling for transparency by the Trump administration over the Epstein files amid backlash. This comes just days after the Justice Department said the matter was effectively closed. Johnson is a close Trump ally and has never broken away so publicly with the president on an issue. And ASML shares are lower after the chip equipment maker struck a cautious tone on its outlook for next year. Tariffs are muddying forward guidance despite positive performance by the company. Its CFO did say that lifting chip controls on China would boost demand. That's your Bloomberg brief. John?
Yahira, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. We'll catch up with Ian Lingen of BMO Capital Markets. Plus, we'll speak to Danny Berger with your morning movers with another look at the big banks on Wall Street.
If you target inflation as your goal, it's backward looking and it doesn't comprehend all of the prices within the economy. It's just a flawed indicator. But one of the things is you switch and you say the dual mandate is to have price stability. So you need lower interest rates because of the strength of the U.S. economy. The U.S. is this giant power and people want to invest in the U.S. even at lower interest rates.
That was the former World Bank president, David Malpass, throwing his name into the ring. into the hat to be the next Fed chair just a little bit earlier on this program.
And you heard me trying to jump in there at the end.
You had some questions.
Well, this is an argument that President Trump has put out there. There's a difference between corporate creditworthiness and sovereign creditworthiness in the developed market, in market perception. And they're saying there shouldn't be. That maybe the creditworthiness of the United States being AA or AAA should allow it to borrow at much lower rates than it currently is, and it shouldn't be tied to inflation.
That's one argument, at least. I'm not sure if it resonates with many people, but it's an argument right now.
It's not playing in markets right now, and I got a lot of response to that from people in the market who might not have agreed with it in any kind of real way. But I do think it's something worth hashing at, since it seems to be something that President Trump is interested in.
Agreed. The opening bell's about 41 minutes away. Equity futures right now just about positive by 0.2% on the S&P 500, following softer than expected PPI data. With the cash open just around the corner with your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Kicking off with another look at the big banks, rounding out this quarter for Wall Street. Solid set of results for all these names. It was about loan growth. It was about trading results. A record quarter for equity trading for any Wall Street bank came from Goldman Sachs, though. All these banks, though, not gaining more than 1%. We saw this with the results yesterday. It is a high bar. Morgan Stanley falling about 0.4%. PNC, some of the regionals also reporting for them. It was also about really strong loan growth. This performing better so far this morning. The consumer looking really good, too. They decreased their charge off. The expectation was that there'd be an increase. Those shares up 1.33%. Finally, Ford, that is dropping in the pre-market. They've had to recall about 700,000 large SUVs. They say for that will be about $750 million. The reason they're recalling them is because apparently there's a leak in the fuel injector, which has been going into the engine that can increase the likelihood that there's a spark and a fire. Probably not what you want with your car. So those shares down 1.33%, John.
Fair to say that's not good. Danny, thank you. Thanks for the update. Not good at all. As we count you down to the opening bell, your trading diary shaping up as follows. After the closing bell, we'll hear from United Airlines. They deliver earnings a little bit later. Thursday, retail sales and another round of jobless claims and Netflix reports. Going into the weekend, Mitch, consumer sentiment. Look out for that. And look out for this next week. One to think about. Fed Chair Jay Powell speaking at the FOMC's regulatory conference. Then tech earnings start to come through. Lots to look forward to. Let's turn back to the inflation data. Ian Lincoln of BMO writing the following. The market isn't viewing June's core CPI breakdown as a gradual response to tariffs. Instead, the sentiment appears to be that it's just the tip of the iceberg. Ian joins us now for more. Ian, good morning.
Good morning. Happy to be here.
Let's break it down like this. Goods prices are telling the Fed to wait. Services prices might be telling the Fed to cut. Which one should they put more weight on?
In this economy, it should be service prices, particularly because of the nature of the goods inflation. Goods inflation is being driven by tariffs. Tariffs are one-off increases, not true demand-driven inflation. So I would be more focused on the service sector at this stage.
If the Fed were to cut, though, how worried are you that it would be perceived as political and actually leading to unmoored inflation expectations, i.e. higher, longer-term yields?
I do think that the Fed will need the justification of the data between now and September, which is the first earliest cut potential, to justify moving. If not, they'll have to wait till October or later in the year because they can't be seen as giving in to political pressure because it's the credibility of the Fed at stake.
If they don't cut rates, do you see the potential for a severe weakening in the U.S. economy that could lead more of a bit into the long end? But this idea that people start to realize, well, maybe these are particularly restrictive rates based on the consumer discernment that you're seeing in the data?
Well, the first observation that I would make is if they don't cut rates, that will probably bring down 10 and 30-year yields, because that implies that they're going to fight inflation more aggressively than the market is assuming at this point. So that would ultimately be a curve flattener, which probably doesn't have the same ramifications for risk assets, for equity. So I would be less concerned about economic performance and more concerned that the market attempts to front load all of the rate cuts into the June 2026 meeting when the new Fed takes the reins.
Just taking a step back, I'm still trying to process David Malpass's argument, and this is something that we've heard a lot, and I'd love your thoughts on this. The idea that the only reason why people see yields as a measure of expected longer-term inflation is because the Fed views it that way. And if the Fed changed the way they viewed it, markets would view it differently, and they would view it more as creditworthiness. The United States is going to pay its bills, so it should be able to have the privilege of borrowing at a very low rate. Do you buy that?
So that argument doesn't particularly resonate with me, frankly. I think that what that argument does attempts to sidestep is the relevance of the dollar and the relevance of the dollar as the reserve currency. What we have seen during the Trump administration is the dollar has steadily declined in part because of the global trade tensions and what that means for treasuries as a safe haven asset. At the end of the day, as long as the Treasury Department continues borrowing in dollars and can print dollars, then credit worthiness should be very high. We also have the issue of the debt ceiling and those moments in which it appeared that the U.S. would choose not to pay. So there's another dynamic that suggests that it should be the global fundamentals that drive 10 and 30-year rates.
Based on everything you'd said previously, I was hearing an argument for lower bond yields on a 10-year, on a 30-year. Is it fair to say you're communicating that argument to clients? Is that what you're expecting now? Is that what you're looking for?
Certainly with 10-year yields at 4.50 and 30-year yields at 5%, I see more potential for downside in yields than from upside from here. I am constructive on the Treasury market. I do think that we're entering a very uncertain period over the course of the next several months, but ultimately it will all resolve in lower rates and a familiar rate environment.
You're making really strong arguments. Essentially a Fed distracted by goods prices, boosted by a one-off tariff shock, not paying enough attention to services prices which are declining, so staying on hold too long, a bias to wait, forcing yields down at the long end on 10s and potentially on 30s.
The longer the Fed remains on hold, how much can you see a bid into the long end? And is it just the U.S.'s game alone to play? Or is it beholden to a global story increasingly where suddenly Japan is jerking around the U.S. market?
Well, let's finish on that. How much of a disruption is Japan at the moment?
At the moment, I think it's a good touchstone for the bond bears. We're looking around at the rest of the world and, hey, U.S. rates should be higher because Japanese rates are higher at the moment. Don't know if I buy that argument.
You're like the silent assassin you are. So measured,
exactly
diplomatic.
What I was thinking.
Just killing the
bears.
I
mean, just quiet, that's fodder for the bears. And they like to look at Japan.
Ian, appreciate it.
Thanks.
Smart arguments, thank you. Ian Lincoln there of BMO Capital Markets. They're credible arguments for lower interest rates. Data can change. I know we've got limited data sets right now, but based on the data of the last 24 hours, that's where things stand.
You could see rents going down. You could see home prices going down. You could see service prices going down, which you hear from a lot of executives. There's a lot of discernment, and that's speaking to a bit of weakness.
Equities this morning positive by 0.2% on the S&P 500. The earnings holding up for the big banks on Wall Street. More earnings coming up in the next 24 hours. Coming up tomorrow, Mike Wilson of Morgan Stanley, Krishna Mamadi of Lafayette College, Francis Donald of RBC, and Lisa catching up with the United Airlines CEO, Scott Kirby from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.